Chairman, Bangalore Branch, CA Manjunath sir, to please escort both the speakers, CA Padamchand sir and Chythannya sir, to the dash. Chairman, please greet both the speakers with applause. Thank you, Chairman.
Good morning, member. Namaste. It's my privilege to introduce our both the speaker, CA Khincha sir and Chythannya sir. I am extremely happy to introduce the speaker, CA Padamchand sir. Padamchand sir is a commerce graduate from Bangalore University, securing 5th rank at the university level. He holds a bachelor degree in law. He qualified a chartered accountancy in 1982 by securing the 25th rank. H. Padamchand sir is a partner at HC Khincha and Company Bangalore. With over 43 years plus experience in corporate and international taxation regime, he has spearheaded the income tax consultancy and litigation practice. He has represented large corporate in some of the high-profile cases before the various income tax tribunals across India, and he has associated with several landmark decisions too. Padamchand sir is a prolific writer on the various topics in income tax. He has co-authored Tax Holidays under Section 10A and 10B and Analysis, Tax Treaties of India, a compilation, Capital Gain of Non-Residents, Tax Deduction at Source, Concept of Indexation under the Capital Gain. He was instrumental in making a critical analysis of direct tax code as a member of team constituted by ICI on the request of CBDT. With this brief introduction, I present before you CA H. Padamchand sir. Now I have privilege in introducing our esteemed speaker, CA Chythannya sir. Chythannya sir is a commerce graduate and law graduate and a fellow member of Chartered Accountancy. Chythannya sir has secured 8th rank from Karnataka State in PUC second year, 1st rank in BCom from Mysore University, 47th rank in CA Intermediate, All India level, and 15th rank in CA Final All India level, topping Karnataka State. He has done his article with PwC Bangalore and industrial training from Hindustan Lever Limited Bangalore. He has practiced as a chartered accountant over 14 years and then as an advocate for 17 years in various high courts and Supreme Courts of India. He has been designated as a senior advocate by Honorable High Court of Karnataka on 14 December 2021. He has lectured in India Institute of Management, ICAI and DTC on Income Tax Department and the various other forums. He has presented paper on income tax at various metro cities and other cities at a forum of ICAI, BCAS, CTC Mumbai, IFA, Society of Auditors, IFTP, BCIC, etc. Was member of study group of ICI for forming guidance note on transfer pricing. Co-authored the books of Tax Holiday under Section 10A and 10B, decoding the Section 5 matrix of MLI. With this brief introduction, I present before you Chythannya sir. Thank you.
Members, I'd just like to brief upon the overview of today's program. So we have the sessions on structural changes on and overview of the Income Tax Act 2025, repeals and savings, charges provisions under the Income Tax Act 2025. We have a tea break in between, as well as the same follows with in the afternoon after the post lunch we have capital gains under the Income Tax Act 2025. That's it. So in between we have our esteemed Member CA Prakash Agre sir, who will be gracing the occasion. Okay, thank you.
The chairman and other office bearers of Bangalore branch, Chythannya, and distinguished participants here. Me and Chythannya thank the Bangalore branch for giving us this opportunity to read, discuss, debate, and then present before you the transition that is happening today from the 61 Act to the 2025 Act. We are having some interesting times in our professional life, where we have had changes to the international tax domain, we have had changes to the GST domain, we are now having changes to the income tax domain. And as a professional, it amounts to a significant amount of devotion to get equipped with the changes that are happening. Changes are at a very fast pace. And therefore, conferences like this, where the entire dedicated course is happening, give us an opportunity for us to deliberate and become familiar with what the law is going to visit us from April 2026 onwards. Very few people have had an occasion to see the transition from 22 Act to 61 Act. You should have been in practice in about 65 years ago to have had the benefit of that. Hardly anybody is there today who is now having the benefit of having the transition. I'm making this point very specifically because we need to be aware of what will happen when we have 1st of April 2026 dawning upon us. That could be the focus of our discussion today. That is section 536 of the new Income Tax Act would be the focus of our discussion, because we have not had this occasion, as I mentioned earlier, to see the transition from a particular regime to a new regime. So how do we transit, how do you go about, shall be a matter of some discussion, some deliberation, in some depth at least. But before that, we will also look into some provisions of the Act, sections 3, 4, 5, 6, 7. 8 is dealing with capital gains. We therefore not deal with 8. We'll come to capital gains. Somebody else who's dealing with capital gains would have the occasion to deal with that section 8. 9. So sections 3 to 9, without section 8 in between, will be the focus of the first part of the deliberations. Thereafter, we'll have 536 as the second part of our deliberations. How do we go about that? Because we're transiting to a new law, the government is professing to make a statement that this is only some sort of a elegant arrangement of the provisions concerned. Nothing new we are trying to achieve. There are no policy changes. We only want to make the act simple, lucid, easy to understand, easy to read. But we are not intending to bring about any fundamental change to the provisions of the act as existing today. But the question therefore for us would be, if in the process of simplifying the language, if in the process of making a statement that the act should be more readable, if we are making certain changes to the provisions of the act concerned, we have to understand the ramifications of those provisions. And when we try and read those provisions in the new setup, are you going to make a statement that, look here, this provision is now in a changed format. It is possibly giving a slightly different meaning. But am I going to ignore that meaning and go back to what would have been the position as understood under the 1961 Act? That will be a very interesting proposition. And I'm making this statement for the reason that as we go about towards the discussion today, we'll have very many occasions to consider the changes between the 61 Act and the 2025 Act, which appear to be innocuous, but can possibly give rise to significant implications on that. And I'm making this statement conscious of the fact that courts have very clearly said, you need to look at the law literally. The Parliament is required to express itself through the letter of the law there. Context will come much later. Text is more important. Context can come a little later. It doesn't come as a primary situation or a primary tool of interpretation concerned. So when you look at the law literally, we then have to find out as to what changes are being achieved and whether those changes are really explaining, clarifying the old law, or they are laying down new propositions. The government made a statement, I don't want provisos, we don't want explanations. Therefore, we are going to carve them out into a separate subsection. A proviso is actually functioning within the domain of a particular theme. There's a provision of law. The proviso goes and interplays with that provision of law, tries to make certain restrictions onto the operations of that main body of the provision concerned. And therefore, when you look at a proviso added to a section, we call it a single theme. We call it a single subject matter for discussion concern. When you remove the proviso out and carve it out into a separate subsection, then the question therefore is, the single theme that was there with the main body and the proviso is now broken. We now have to give as much relevance and importance and significance to the new subsection as we give to any section under the Income Tax Act. That becomes very interesting, and we'll have many occasions today when we deal with the provisos and explanations concerned, which we are having a particular role to play in the existing context. When they have been converted into a separate subsection concern, what is the impact of that changeover from a proviso or an explanation into a subsection? My suggestion therefore would be kindly watch. We will therefore display, if wherever required, the old act and the new act. We will within the new act also display on the screen the wordings concerned and leave it to you to follow the text. And we are making a point concern to say that because of this subtle change, because of this change in this context and setup, we are going to make certain propositions concerned. We would like to therefore look at those propositions, and if you think they're agreeable, fine. If you think they're not agreeable, possibly you'll get into the thought process of asking yourself a question concerned. I'm not agreeable to what he's saying, but nevertheless, I have my own viewpoint. That itself is a very significant achievement for us, that when we are compelling somebody else to learn, to think about a provision and about our viewpoint, our purpose will be largely achieved. Our purpose will be largely achieved. Technically, when you look at the law concern, look at the development that has happened in the 61 Act. That came about as a result of the Law Commission report in 1958, that came as a result of the Direct Taxes Enquiry Committee. There were two committees. They made a detailed study, and then they recommended 1961 Act to come into picture. Under the current regime or current dispensation, the whole thing has been done by an internal departmental committee of the government from the Revenue Department side. Logically, therefore, when you look at a tax department, when he is both the adjudicator as also a judge, you will find some tinge, some sort of a inclination to make the law more favorable to the revenue. Although the government says we don't want to bring a policy change, we find some elements of changes being brought about that give a hint or a color that this possibly is a very significant change, moving the regime towards a benefit to the revenue, not necessarily a benefit to an assessee concern. Not necessarily a benefit to a concept also, but benefit to a revenue itself directly. In the light of this, it is actually appropriate, if you want to make a correct analysis of the law, to go into the 61 Act, look into the 2025 Act. But before you look into the 2025 Act, we have had certain developments in the intervening. Those also become very relevant. The bill as it came in the original format for the comment from the public concern, government had its own draft. Then it invited stakeholders to give comments. It appointed a select committee. Select committee gave its report. They brought in certain changes based on the comments from the stakeholders concerned from the select committee report. They gave a new draft of the income tax. So we had a third position. Then they said, government said, no, we are withdrawing this. There are some more changes to be brought about. We are now reintroducing one more bill after bringing about certain further changes that we think are required to be brought into the statute concern. So we have a history of developments concern. Ideally speaking, we should have a track of all of this, understand the flow through all of this to find out what is the final product coming about. We will not spend so much of time on all of these facets concerned, but that's an important point for us to bear in mind when we are looking at a very correct analysis and a meaningful analysis, a deep insight into what the provision of law should convey to us. We will therefore have, what I'm going to do is, possibly I'm going to give an outline of the provisions of the law, very brief outline, and the technical points are going to be dealt with by Chythannya. We are making this effort conscious of the fact that some element of explanation, some sort of a preface is required for us to be prepared to be handling the new issue that come about. So when we are doing it section 3, 4, we are used to the sections 3, 4, 5, 6, we are all used to the sections. But rightly or wrongly, in the process of simplification, in the process of converting a proviso to an explanation, in the process of adding few words or eliminating few words concerned, significant changes are possible to be imagined, to be seen, and to be visualized. Therefore, we are going to go into some sort of a commentary between the 61 Act and the 2025 Act. To that extent, there may be a repetition concern. I will therefore give a broad outline of the philosophy of the section concerned, and the contents thereof shall be dealt with by Chythannya concern. So we'll therefore begin with section 3 of the Income Tax Act now, 2025, that deals with the concept of a tax year. We had the concept of a previous year, we had the concept of an assessment year. Now, those are now sought to be given a go by. We are going to have a tax year. This is professed to be one of the most important changes in the entire philosophy of the Income Tax Act. They're saying that this is going to give rise to a amount of simplifications concerned. And therefore, they had to define a new term today. Tax year is a new term, therefore. We had some sort of a previous year definition, but they necessarily had to define tax year for the first time. And interestingly, if you see that provision of the tax year, you will have some sort of a understanding as to what is the shortfall, what is the shortage in the terms of the law. For example, I will I'll make a mention about what is the definition of a tax year. Means the 12 months period. 12 months period of the financial year. Is financial year 12 months period? Is it necessary for you to say 12 months period of the financial year? 1. 2. Do you use the word periods, 12 months period, or you say 12-month period? Period comprising of 12 months is better. When you go forward, you don't use the word 12 months period. Therefore, there is some element of not proper application of the language, grammar. Anyway, that is a point for us to look into in terms of an ultimate battle. May not be very relevant in terms of the impact of the outcome for a tax year concerned. But what's important for us to understand is, when we look at tax year dawning upon us on 1st of April 2026, what will be the concept of assessment year and previous year? Would there be some sort of an overlap? Are you going to have in 27 year ending, you're going to have an overlap between the assessment year, tax year, previous year, financial year? What will be the interplay between all of these terms concerned? How are we going to go about? A deeper insight of that will happen when we look at section 536 that deals with transitional previous year concern. And we therefore have a situation where the proviso to section 3, subsection 1 speaks about a new business coming into existence or a new source of income coming into existence. There is a proviso to section 3. They have removed the proviso and made a separate subsection to say that what is the proviso erstwhile will now become 3 subsection 2 of the new act. So when you have a proviso being removed and that is constituting a new subsection now, we'll have an occasion to understand as to what will be the way in which the impact of this proviso being carved out into a new subsection, how does it pan out in terms of the actual impact. Section 4 had 2 subsections. We are now making it 5 subsections. A proviso to 4.1 has become 4 subsection 2, and we have some new sections in the whole process concerned. What is the role of section 4 is a charging section. What are the charge? What does it bring to tax? It says the total income of a previous year shall be brought to tax or shall be charged to tax. What shall be therefore charged to tax? On the total income, you shall pay income tax. You shall also pay additional income tax if the law were to demand that apart from the basic tax, you are also required to pay additional income tax. So now, we are therefore having section 4 today, providing for the levy of income tax as also the levy of additional income tax. But look at the way in which this setting has happened. Whether it's possible to argue differently, whether it's possible to make a statement that there is some confusion in this law concern, whether income tax includes additional income tax, whether income tax is separate from additional income tax, whether additional income tax therefore is to be independently levied as compared to the income tax. Be mindful of this aspect concerned when a provisor of section 4.1 is now coming as a new subsection itself. Section 5, hardly any change. But I will make a statement and keep quiet, and I would like you to imagine this. Section 5 deals with what? Scope of total income of a resident, scope of total income of a non-resident. 5.1 deals with resident, 5.2 deals with non-resident. 5.1, when it deals with the scope of total income of a resident, has clause A, clause B, clause C. Wordings are identical in the 61 Act, in the 2025 Act, except under the 61 Act, when you have clause A, at the end of it we have or. At the end of B, we have or. That is A, or B, or C. So your total income shall comprise of income received or deemed to be received, incomes accruing or deemed to be accruing, or income arising outside of this country concern. So a word or is there between clauses A and B, and between clauses B and C. The word or in the new act is removed from or between clauses A and B. It only remains between clauses B and C. A small elimination. And I would like you to imagine and come back to say, what is the impact of a small or between A and B having been eliminated? What will be the impact or ramification of that? So it's important for us to bear in mind the fact that although the law reads consistently some sort of a continuing same language, but in the process of changing over, some material words have been eliminated, and we have to be mindful of these material words being eliminated, to identify those points concerned, those words concerned, and then go on imagining what shall be the impact of either an insertion or a deletion of a particular word. When they are now trying to copy, they've copied it. But what happens is when you are eliminating a word concerned, what will be the impact of the elimination of that word becomes a significant point for our discussion and debate and thought process. Section 6 also we had subsection 6 there, 6, 1, 2, 3, 4, 5, 6. In the new law, we have 14 subsections. This whole problem in between 5 and 6, under 5 also we had 2 explanations that come in as 2 subsections now. In section 6 also we had a lot of explanations concerned. What happens when a person leaves the country for the purpose of employment? What happens when a person comes into India when he is staying outside the country concerned? We had particular law being laid out to say whether we'll have the benefit of an extended stay, when we'll have the benefit of extended stay, what happens if his income in India is more than 15 lakhs, what happens if income in India is less than 15 lakhs. We have a lot of circumstances all clarified through the provisos and explanations to section 6. These explanations and these provisos have now been brought into new subsections. We therefore have an interesting occasion to understand the interplay between these new sections concerned, and there will be some very startling results because of the impact of new sections being added and the coordination between these sections not appearing to be very elegant. Section 7 also deals with the aspect of, we have section 7 and 8 under the 61 Act, 7 talking about which are the incomes deemed to be received by an individual concerned, accumulated balance and the transfer balance of a PF. And we had section 8 dealing with dividend taxation. Section 7 and 8 of the 61 Act have now been converged into a single section, section 7 of the new Income Tax Act. We'll have an occasion to refer to that section 7. This will be part 1 of the first session. Then we will deal with section 9 of incomes deemed to accrue or arise in this country and find out what the ramifications are. And if there is a situation that we complete this section 9 also, we'll transit into a little more detail into 536 after the tea break concern. So over to Chythannya for explaining to us the provisions of the impact of and the ramifications of sections 3, 4. We have had some occasion to discuss earlier, but because the changes have been made to the Act from the original point of the bill, a lot of recommendations have been accepted. They have made some changes. I'm not saying, therefore, that the first draft of the bill was a little more shoddy. They have improved by virtue of the recommendations being adopted. Therefore, they are making it a little closer to what the current law is. To that extent, there is some element of improvement from the original bill to the ultimate shape in which the act has come about. But still, there are certain shortcomings, and therefore, we'll have to bear with us if you've already made this point earlier, to go through the provisions again and ensure that we are now convinced about the impact of the new provisions in the terms of sections 3 to section 7 of the Income Tax Act. Thank you.
Thank you, Padam sir, for introducing the subject. And I reiterate our gratitude to the Bangalore branch for giving this opportunity, which otherwise we would generally have once a year after the finance bill is out. And we are also fortunate that the Bangalore branch did not call us when this Income Tax 2025 bill came in its first avatar. It would have been disastrous. Fortunately, the Finance Ministry in its wisdom thought it fit to withdraw the bill and reintroduce the bill. Also considering the age and health of the Finance Minister, because if that bill, subject to as many as about 300 amendments, were to be introduced in its existing form, our FM had to rise and sit down at least 300 times in the Parliament, because each amendment to the bill would have to be separately mentioned. As Mr. Padam said, we would now focus on the elementary sections of the Income Tax Act, 3, 4, 5, 6, and to be followed by 9. If you would read this ITA 2025, ostensibly it just looks like rearrangement of 1961 Act. And their policy statement also is very clear that they would not want to have any policy change, which would also mean that the judicial interpretations of 1961 Act should be carried and implemented with full spirit even in the 2025 Act. But then when you would go through these provisions more carefully, you will find that it is not just rearranging sections, it is not just trying to reduce the size of 1961 Act. It is also certain things which, if I may take the liberty of using this word, mischievously introduced, mischievously substituted with absolutely no reason whatsoever. Very subtle change, but could have material impact. On either side, some of these changes would benefit the taxpayers, some of the changes would benefit the Income Tax Department. And they are not carried out an impact study of reckless conversion of provisos and explanations into subsections. What we have tried to do is to go highly technically about the sections on the basis of our first-hand reading, which we don't claim to be necessarily correct. We are all like the students of 2025 Act. So our analysis may not be right, may not be acceptable to you, and may surely have scope for different interpretation. And some of them may not really be material. But then this is an opportunity for us to get into academic part of the Act of 2025, which would gear up to deal with this Act should controversies and the complexities arise in future. So you'll have to excuse us if we tend to be too technical. Now, looking at section 3 of the Income Tax Act of 2025, as Mr. Padam rightly stated, that they have removed the concept of previous year and the assessment year, and they have brought in the tax year, which is almost the same as the previous year. And you could see the definition of section of the tax year as per 3.1 in this slide. But then if you would look at it a little more carefully, it does refer to 12 months period of financial year commencing on the 1st of April. But if we go to section 321 of the General Clauses Act, the financial year itself is defined as the year that would commence on 1st of April of 2021. The word financial year is not defined. So, under the General Clauses Act, the financial year is defined. So, you are expected to interpose the definition of financial year into section 3(1) of the ITA 2025. That would make it quite a surplusage reading insofar as commencing on the 1st of April is concerned. Like, if you would read the financial year as defined in 321 into 3(1) of 2025 Act, it would read like this: tax year to mean the 12 months period of the year commencing on the 1st day of April, commencing on the 1st day of April. This is how it would look like. So, they have not taken proper care to, as they redid the act, they ought to have taken proper care. Anyway, this may not have much of an implication, so let us not really bother much about it. But then what is more important is, under 1961 Act also, in the definition of previous year, we had the case of a truncated previous year. What is this truncated previous year? Typically, it is period of 12 months of the financial year. Immediately preceding the assessment year is the previous year. But then they dealt with certain situations where if a business is newly set up or a new source of income comes into existence, then the previous year wouldn't have begun from the 1st of April, it would rather begin from the day on which the business is so set up, or the new source of income so comes into existence, and it would end with the financial year. So, you will have a truncated previous year. Actually, there was no need even under section 3 of the 1961 Act after they introduced the uniform financial year. Earlier, we had non-uniform financial years or the previous years, where for each source of income we could have had a different previous year. That was all done away long back in the 1961 Act. For some reason, during the transition period or whatever, they would have retained. They have not even understood why that provision was kept in the 1961 Act. And if their intention is to really reduce the size of the Income Tax Act of 2025, they could have dispensed with section 3 subsection 2. What it says, where a new source of income comes into existence or your business is newly set up, your previous year then wouldn't begin from 1st of April, it will begin from much later. And if this becomes the previous year, you will have a lot of issues later on as you determine your residential status. For example, under section 6 of the Income Tax Act, either of 61 or of 2025, a residential status of an individual would depend on the number of days of stay in the relevant previous year. So, you will have 182 days, you will have 120 days, you will have 365 days of 4 years, you will have 60 days in the relevant previous year or the tax year. Now, imagine a situation where your new source of income would first ever come into existence on, say, 3rd of February of a particular year. Then your tax year will be from 3rd of February till 31st of March itself is less than 60 days. So, invariably you are a non-resident and your overseas income will have to go away without tax. So, this is not required at all. We had this issue earlier, we could have done away with that now. And what if multiple sources of income would come into being at multiple points in time? Then you will have a situation of multiple tax years. Of course, you have section 6 within brackets 12 of 2025 Act, which says that if you are a resident for any particular source of income, you shall be deemed to be a resident for all your sources of income during the relevant tax year. That would address a situation where when you would have multiple tax years depending on multiple sources of income coming into being in a particular tax year. So, all this could have been immensely avoided. But for this, there is no other change in section 3 of the Income Tax Act. Now, let us go to section 4 of the Income Tax Act. If you had seen the original version of section 4, you would have had the shock of your life. See, section 4 is such an important provision, and how much of care ought to have been taken. And section 4 of 1961 Act stood the test of time. It hardly saw any amendments since its enactment in 1961. So, it would have been easy for them to have adopted, but for change of assessment year and previous year to the tax year. They did not do it in the original avatar of this bill. They thought they would, innovate the charging section, and in the scheme of that, they ended up making this section completely erroneous. Fortunately, when several recommendations went to them, they had the mind to consider that and reintroduce Section 4 largely in its original avatar. Otherwise, it would have created a conflict between the Annual Finance Act and the Income Tax Act in its original avatar. But then still, there is some issue. This issue arises as a result of what is otherwise part of a subsection. If that is carved out into a separate subsection, how does it gel well with the intention that is to be carried out? Look at this Section 4, subsection 1. It's largely same as Section 4, subsection 1 of 1961 Act, except that it will carve out by way of subsection 3 the additional income tax by whatever name called levied under Income Tax Act. So if you would see, 1961, you could see it on the right hand side. You will find the bracketed words. I'll read this section. Wherein is Central Act enacts that the income tax shall be charged at a rate or rates. Income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provisions. Now look at the bracketed words in Section 4.1 of the 1961 Act. Including provisions for the levy of additional income tax, brackets close of this, in respect of total income of the previous year of every person. They are almost retained in its existing form. In the new Section 4.1, there is no problem as such. As I said earlier, problem is subsection 3, wherein if you look at subsection 3, income tax shall also include any additional income tax by whatever name called levied under this Act. Now, if you look at the Income Tax Act, you would have 2 or 3 occasions where there is a levy of additional income tax. One could be a case of secondary adjustment. You will have a transfer pricing primary adjustment, then you are expected to make a secondary adjustment by making appropriate entries in your books of account. If you do not do it, then there is an imputed loan and an imputed interest thereon. If you want to avoid it, you can pay an additional income tax under 92 CE. That is one such instance of an additional income tax. Second is the case of accredited tax, where you are a charitable trust eligible for exemption, and if you cease to enjoy exemption under specified circumstances, then you will have to pay 30% tax on your net asset of the charitable trust at the time you cease to exist for charitable purpose. Third could be a situation of updated return. When you would file updated return, depending on when you would file, 1 year delay, 2 years delay, 4 years delay, have to pay the additional tax. So these are the 3 cases of additional income tax. The 1961 Act, Section 4, subsection 1, in its basic premise of charge, also included the charge of additional income tax. So it was going very well. Now that the levy of additional income tax is separately carved out, some of us tend to argue that, look, the basic charge is under Section 4, subsection 1, which means whatever is the rate that is given in the Finance Act, and if that tax is so levied under subsection 1, which is called as income tax, what does Section 4.3 say? It says income tax that we pay under subsection 1 shall also include any additional income tax, meaning I do not have to pay it additionally, because the income tax that comes under 4.1 will have the additional income tax subsumed into it. This is the language they have used. The income tax shall also include the additional income tax. Where is the levy? I am not saying this is going to be the proposition which the courts would necessarily accept. I am only trying to say the kind of callous attitude they have had as they drafted such an important provision like Section 4. In an extremely difficult situation where really pushed to wall, possibly you could take this argument. Not necessary that you would succeed. This is about Section 4 of the Income Tax Act. Now let's go to Section 5. But one good aspect of Section 4 of the Income Tax Act is, if you would see Section 4, subsection 5, which reads, for the income chargeable under this section, income tax shall be deducted or collected at source or paid in advance as provided under this Act. So TCS is also now incorporated in 4 within bracket 5, which is not the case in the present section 4 of the 1961 Act. So to that extent, it's a welcome measure, because otherwise TCS would have stood without the support of the charging section. Now let's look at section 5, subsection 1, which will deal with the case of scope of total income of a resident. You will have the scope of total income of a resident, which invariably would mean income received or deemed to be received in India, and income accrues or arises or is deemed to accrue or arise in India. Then you will have income that accrues or arises outside India, which essentially meant that a resident would have in his scope income wherever accruing or arising. It wouldn't really make a difference to him as to whether it accrues in India or accrues outside India. But the case of a not ordinary resident is carved out. In the case of a not ordinary resident, an income that accrues outside India or arises outside India would not be included in his total income unless it is derived from a business controlled in India or a profession set up in India. Meaning, a not ordinary resident is treated almost at par with a non-resident, subject to one exception, that if such not ordinary resident derives income from a business controlled in India or a profession set up in India, even if such income accrues or arises outside India, he will have to pay tax. But for this, he is treated at par with a non-resident. This was very carefully drafted in the 1961 Act. Now look at section 5(1) of the 2025 Act. The long portion, the beginning long portion remains unchanged. Clause A remains unchanged, except that, as Mr. Padam rightly stated, after semicolon, we ought to have had a word or, which is missing here. See, typically what would happen is in the income tax, when there are multiple clauses, how are these clauses separated? It depends on whether these clauses are intended to be conjunctive or disjunctive. If they are to be cumulative, then the practice is semicolon, semicolon, semicolon for every clause, and at the penultimate clause, semicolon followed by end. For example, you take section 220, subsection 2 capital A, waiver of interest. You will have a semicolon, you will have a semicolon, you will have a semicolon, and then followed by the last clause. This came before the courts to interpret and have said that if you put semicolon at the end of every clause and the penultimate clause semicolon followed by end, which will mean all these have to be understood as cumulative. Instead, look at the present section 4 of section 5 of the Income Tax Act, 5(1). After each clause, semicolon or, which will mean what? They are not necessarily cumulative. Therefore, it is enough for you to have income accruing in India to be included in your total income. You don't have to have income accruing outside India. Now, here they have just missed out writing anything, neither or nor and. We will not even know as to what could be the implication of this. Leave that out for a while. This appears far too technical. I don't think anyone can do any planning out of it. But look at clause C here. See, clause C, which will deal with the case of scope of total income of a non-resident, which would even include the income that accrues or arises outside India. How does it read? Accrues or arises to such person outside India in that year. There is a comma, then the word but comes. But, comma, but when such person is not ordinary resident in India, under section 6 within brackets 13, Such income shall be included only when it is derived from a business controlled in or a profession set up in India. On a cursory reading, it doesn't make any difference. But when we get into the syntax issues and the meaning of comma preceding the word but, we did a Google search. The AI search, the Google suggests that if you put a comma before but, it would mean what follows thereafter would convey a completely independent and separate meaning. And to give an example, she wants to go for a walk, comma, but it rained the whole day. She wants to go for a walk, comma, but it rained the whole day. They are completely independent. You could either write them together by putting a comma and followed by but, or you could make it into two sentences. She wanted to go for a walk, full stop. It rained the whole day. Meaning, by putting this comma and but, what have they done? They have carved out this and made this as a separate portion, not necessarily confined to class C. Which will now mean what? A not ordinary resident would not only get the benefit in respect of class C, he would also get the benefit for class A and B, and he wouldn't have to pay tax in respect of any income whatsoever, irrespective of whether it's received or deemed to be received in India, or it accrues or arises or is deemed to accrue or arise in India, as long as it is, unless it is derived from a business controlled in India or a profession set up in India. They are not expected to be making such an error here as the draft section 5. Because the whole of the letters that are put in bold for the sake of your easy reading appears to be a separate independent provision. Read it as D. When you read it as D and read with the long sentence with which section 5.1 begins, it looks as though a not ordinary resident is getting huge benefit not intended. He is expected to get the benefit only in respect of income that accrues or arises outside India, not in respect of other two streams of income. But now it's possible for you to contend that he would not have to pay tax on any income whatsoever unless it is derived from a business controlled in India, a profession set up in India. Including the passive income that arises in India, you don't have to pay tax. This is the problem when one party to the game is asked to frame the rules of the game. You don't need an umpire. You will just ask the other opposite side to frame the rules of the game and interpret it. Now this is about section 5. Now we'll move to section 6. Before I go to section 6, there are two subsections to section 5, which also could have been immensely avoided. They have just carried it through from 61 Act to 2025 Act. What does section 5.3 say? See, these two are not the new controversies, the existing provisions, but they could have been avoided. Subsection 3 says, income accruing or arising outside India shall not be deemed to be received in India under this section by reason only of the fact that it is taken into account in the balance sheet prepared in India. See, this was long back during 1922 Act. You had the situation of what is the meaning of received. Then the court had an occasion to, in Raghav Reddy's case, 44 ITR, court had an occasion to say that, look, if your payer, the creditor, credits the amount that he has to pay you in an account on which you have absolute control, such crediting would tantamount to receipt. But no court ever stated that merely because certain income is shown in a consolidated balance sheet prepared, on the basis of place where such balance sheet is prepared, the income is deemed to be received. No court stated that as a measure of abundant caution. They did say so in 1961 Act, and this could have been immensely dispensed with. Nobody would think that an income is deemed to be received if it is included in a consolidated balance sheet prepared in India. Like if you would go to section 4 also, subsection 4 of section 5, it says if certain income is included in a total income on the premise that it has accrued to or it has arisen to or is deemed to have accrued or arisen to, it shouldn't again be included in the total income again on the basis that it's received by you. This is only as a measure of caution, because once an income has accrued to you, what you thereafter receive is not income, it is a debt that you receive. There's a difference between receipt of debt and receipt of income. If I raised an invoice on you, and you are expected to pay it to me, and it becomes thereafter a debt, so all your recoveries from the debtors cannot be called as income received. They're all the debts recovered. So this is the basic premise of the meaning of receipt and accrual. Anyway, they have had it as a measure of abundant caution, which we will possibly have to put up with. Now let's go to section 6, which deals with the residential status. There is some problem in section 6 again. Look at 1961 Act section 6, subsection 1, which will deal with the case of an individual. Your clause A, B is not there, clause C of the 1961 Act section 4 subsection 1. Two basic conditions. What is the first basic condition? If you are in India for a period of periods amounting in all to 182 days or more. Look at how carefully it was drafted. If he is in India for a period of periods amounting in all to 182 days or more, which will mean even if your stay is in India in split periods, all would have been aggregated by using the language for a period of periods amounting in all. Look at how beautifully they have addressed it. Even if you would see the double taxation avoidance agreements, Article 5, which will deal with determination of permanent establishment in special cases where you have service PE, installation construction PE, where they will have specified number of days beyond which it would trigger a PE for you. They are known to use the similar language for a period of periods aggregating in all. In place of that, such an important section 6 subsection 2, clause A, you see this. An individual shall be resident in India in a tax year if he is in India for a total period of 182 days or more in the tax year. They wanted to reduce the size of the Income Tax Act. For a period of periods amounting in all would have meant a longer act. So I'll cut it, make it as a total period of 182 days or more. Not that they are unmindful of a better language. Look at clause B. Is in India cumulatively for 60 days or more. Would have been the more appropriate language to use. Cumulatively for a period of 60 days or more would have definitely considered and appropriately substituted the period of periods amounting in all to 182 days or more. They are aware they have used it. But they have been very careless insofar as clause A is concerned. They have said for a total period of 182 days or more. So there is in fact a decision of the Honorable Supreme Court in the case of B. Shah versus Presiding Officer Labour Court, where the Supreme Court had an occasion to determine what is the meaning of period. So period would mean a fixed length of uninterrupted time. So with this definition of period, come back to section 6(2)(a), total period of 182 days or more would mean you can consider only one period, you cannot consider multiple periods. So this is an error that has taken place here. So it's possible for now people to argue, as long as they don't get hit by clause B. People who have already been staying overseas may easily overcome clause B, which has a condition of 60 days in the previous year and 365 days in the last 4 tax years. That could be avoided by a person who is generally staying outside, and if he is likely to get caught under clause A, it becomes a lot easier for him to continue to remain as a non-resident by arranging his stay in splits. And this has to be amended. It cannot remain like this. which will mean you will have some sort of an amendment coming. We will not know how the amendment is going to be brought in. Whole idea is not to have amendments. Whole idea of 2025 Act is to have as less amendments as possible. You would see in the next 3 years, you will have the amendments that will take place in the next 3 years will be more than the amendments that have taken place to 1961 Act in the 30 years. Now, as Mr. Padam said, the explanations and the provisos in the legal jurisprudence are known to serve the particular purpose. When you have a proviso, that proviso would generally create an exception to what the main body of the section seeks to convey. An explanation clarifies. They are not independent. Your Sundaram Pillai's case, the constitution bench decision of the Supreme Court, which has explained the scope of proviso and the explanation, they cannot overtake the main body of the section. They always remain subordinate. It's like in your home, your head of home, your children, your spouse would be possibly like reporting to head of family. I have been careful to use the word spouse. And it will all remain as one section within which you will have explanations and the provisos. Certain exceptions could be made to the head of the family or the kid of the family. Certain roles will have to be explained through an explanation. To the one who takes care of work outside, to the one who takes care of work inside. There is requirement of clarification. Imagine a situation where this family is split and the son gets married and goes away. Would your rules of home apply to his rules, his home? No. Then how would you suture them together unless you take appropriate care? During the weekends, they will have to meet at one place and follow the rules of that home. So there has to be some important, suturing that has to take place. If you intend to control them, and without doing it, if you simply split it, you will have an issue. That's the kind of problem that is happening here. So you will have explanation to section 6.1. So 6.1 will give you the basic rule of 182 days or 60 plus 365 days. When it comes to the second condition, 60 plus 365 days, then you have the explanation of 1961 Act, which would state that if you are, there are two exceptions there. If you are a citizen of India or a person of Indian origin, and if you leave India as a member of crew of an Indian ship or for the purpose of taking up an employment outside India, then in second condition is virtually rendered nugatory in as much as you would not become a resident unless you stay in the relevant previous year for 182 days or more. That's the condition. Meaning this 60 plus 365 days condition would be dispensed with. This was coming as an explanation to section 6.1. Meaning it stayed within the scope of section 6.1 and operated. In as much as it gave you that benefit only in the year in which you have left the country. Are you able to hear me? Only in the year in which you have left the country you would have got the benefit. Because explanation and subsection 1 were not separate. They were together. They had to be read together. Now, look at this. Please see this. You will have whatever was as explanation 1A, which dealt with a person of Indian origin or a citizen of India leaving India for the purpose of taking up employment. Look at the language here, shall apply in relation to that year. Look at how carefully it was done. The benefit of you being called a non-resident, a benefit of you having to necessarily stay for 182 days would be available only in the year in which you have left the country for the purpose of employment. Thereafter, if you would come, you would not have got the benefit. Thereafter, you become the resident, you would not get that benefit. You will come back to be treated like any other resident, any other individual. Instead, now it is carved out into a separate subsection. In the 2025 Act, it will become section 6, subsection 3. And if you see the language here, the provisions of subsection 2b shall not apply in the case of an individual who is a citizen of India and leaves India in any tax year. In any tax year, then you would not have the condition of clause B. So that means once you leave the country for the purpose of employment, rest of your life, you would not have second condition applicable to you. So they have not taken proper care even to compare the old act and look at the words there. I'll come back again, shall apply in relation to that year. These words are crucial so that the benefit of dispensing with second condition should apply to you only in that year in which you have left the country for employment, not for all years to come. Now, once you are a person living abroad for employment for all your years to come, through your life, you will have condition B not being applicable to you. So similar amendment is carried out in respect of person who is already outside India, who would come to India on a visit. There also, same issue, the words in relation to that tax year or in relation to that year, those words are conspicuously missing in section 6, subsection 4, whereby this benefit would eternally be available to a person who is already outside. Once he comes to India on a visit, matrons, for all the years going forward, he will not have the second condition ever applicable to him. Now, one more thing. Recall section 6(1) capital A of 1961 Act, which will deal with the case of a stateless person. Who is a stateless person? You are a citizen of India, but to move all around in such a manner where you would not be liable to tax in any jurisdiction elsewhere by reason of your residence, domicile, or any other similar criterion. Whereby, what you will do, you keep moving around, don't stay in any country where you will have residence-based taxation, but you remain a citizen of India, whereby you would want to have non-resident status in India and avoid paying tax in India in respect of income that accrues or arises outside India. So they found this mischief and wanted to fix this by saying that if you are such a stateless person, you shall be deemed to be a resident in India. But then they gave a marginal benefit to him, stating that, look, though we call you as a resident in India, we would call you as a not ordinary resident in India. All this was contained in 6(1)A, read with the proviso thereunder. The moment they brought in 6(1)A, whereby if you are a citizen of India and if you are not liable to tax in any other jurisdiction, you would become a resident in India, and thereby they also made an amendment by calling such person as a not ordinary resident. We all shouted there is an error there, even the ordinary people like us who are otherwise residents also will get the benefit of not ordinary resident status, and they then brought in a proviso to 6(1)A to say that, look, this would apply only if you are not already a resident in India. So this came as a proviso to 6(1)A, which neatly fixed the problem by saying that if you are otherwise a resident in India, you would not be deemed to be a resident in India because you are already a resident. So therefore, you will not get the additional status as a not ordinary resident. It's only when you are not otherwise a resident in India and you are a stateless person, whereby you are deemed to be a resident in India, only in such case the benefit of this tag of not ordinary resident would apply to you, is how they structured it very, very well by putting this proviso to 6(1)A. Now what have they done? They have cut this proviso into a separate subsection. 6(7) would deal with a situation of stateless person who is deemed to be non-resident. 6(8) is brought in, section 6 subsection 8 is brought in as a separate subsection to say that 6 subsection 7 would not apply to a person who is already covered by 6(2) to 6(6). That means same thing as what the proviso earlier did. Only change is 6(7), what was 6(1)A and the proviso thereunder have now become 6(7) and 6(8). You may ask me what is the issue there. The issue is there that in 6(13), when they define who a not ordinary resident is, they make reference only to 6(7). They don't say 6(7) read with 6(8). So this is where you'll have to take proper care. Now, because there is no reference to 6(8) at all in 613, whatever problem we had earlier envisaged in 6(1)(a) of the 1961 Act would recur now. See, some of these points which we are trying to explain to you may not really immediately get into your mind unless and until you have read those sections, or those sections are green in your mind. Don't bother. We would have read it several times, so we are very confident of expressing at least rightly or wrongly what we think of it. Don't worry. Keep this issue in mind. Go back in your leisurely time, go through the provisions and see as to whether what we are trying to say makes sense. So these are some issues in section 6 of the Income Tax Act. Now we will not see the stateless person which I have explained, whereby if you are a citizen of India, not liable to tax in any country by reason of your residence, domicile, or any other similar criterion, you shall be deemed to be a resident in India. But there is a condition. What is the condition? Your total income, excluding income from foreign sources, should not exceed 15 lakh. Your total income, excluding income from foreign sources, should not exceed 15 lakh. Now, this is causing a circular function. How would you determine the total income under section 5? On the basis of your residential status, right? Unless and until your residential status is known, you would not be able to determine your total income, because total income of a person who is a resident, total income of a person who is a non-resident, and then only the respective scoping of section 5(1) and 5(2) would apply. Whereas when you would go to section 6, for you to be called a stateless person, they predicate that there exists a total income, excluding foreign sources, not exceeding 15 lakh. How would you determine the total income of that person unless and until you determine his residential status? So it causes a circular function. See, in Kannada we would call it as madve huchu. Madve agde huch bidalla, huch bidde madve agalla. So we'll have a circular function. A person is gone mad because he is not married. He wouldn't be married unless he is cured of madness. And as long as he remains mad, he is not getting married because nobody would give a girl to him. So this is a kind of a circular function that is being caused here. So it's impossible to work around this. This they could have addressed it properly, but they didn't choose to do it. This is the problem in section 6 of the Income Tax Act. Now we'll have section 7, which is largely the same as section 8 and 7 of the Income Tax Act of 1961. Unfortunately, there are not material changes, even minor changes or technical changes in respect of these provisions. So we will not discuss with that. We'll move on to a very important section, section 9 now, and we will then explain certain niceties associated with the newly made section 9. We would have Mr. Prakash Hegde here, who's been elevated as the Honorable Accountant Member of the Appellate Tribunal, and very aptly the Bangalore branch has decided to felicitate him. So we're going to take a small break for his felicitation, not a tea break, felicitation break. Yes.
Members, we are delighted to have CA Prakash Hegde, who has been appointed as the Income Tax Appellate Tribunal Accountant Member. I request the Chairman, Bangalore branch, to please escort CA Prakash Hegde, sir. I request Chairman to please greet Prakash Hegde, sir, with a floral bouquet. Members, I would like to introduce CA Prakash Hegde. Prakash Hegde is a finance and tax professional with over 2 decades of diversified experience spanning advocacy, industry, leadership, He has spent his time for a decade in Big Four consulting. He is a rank holder in BCom and LLB and a fellow chartered accountant with MBA in finance. He has experience in direct taxation for more than a decade. Formerly a CEO at the Totagaras Cooperative Sales Society, CIRSI, and currently an independent practice for 9 years, specializing in direct tax compliances, advisory, and dispute resolutions. A frequent speaker at professional seminars and a published author in newspapers and professional journals. Regular finance and tax columnist for Mint and often quoted in the national publications including the Times of India, Economic Times, Hindustan Times, and the Mint. Native of Sirsi, a place at Uttar Kannada district. Members, it's again a proud moment for the profession and the fraternity. One of our members being elevated as the accountant member of the ITAT. Let us all congratulate him and heartily welcome C.A. Prakash on his appointment as the accountant member of the Income Tax Appellate Tribunal. Sir, your rich experience, professional excellence, and dedication to the field of taxation have rightfully earned you this recognition. The profession will greatly benefit from your insights and balanced approach in this important quasi-judicial role. This is a proud moment for the entire profession, fraternity, wishing you a tenure filled with wisdom, integrity, and your contributions to the field of taxation. Members, we just have small felicitations for our newly elected accountant member for ITAT. I request all the management committee members, our own regional council members, C.A. Pramod Hegde sir, and entire dignitaries on the dais. Members, it's really a happiest moment for all of us. I request C.A. Prakash Hegde to please give a few words to our members.
Respected Chairman of the Bangalore branch of the Institute of Chartered Accountants of India, the Honorable Office Bearers of the branch, as well as the SIRC, as well as the Central Council, the most respected tax gurus. I feel so privileged to be standing in their presence here. Padam sir, Chythannya sir, my dear professional colleagues. It's a matter of great honor for me to be here, that too, to be present in the presence of Padam sir and Chythannya sir, whom I respect the most as my tax gurus. The smallest success, if I have to call this a success, is a result of many of the professional colleagues, my tax gurus, whom I very cautiously, very carefully followed all these years. The first credit should go to my parents, family, and my guru with whom I did my CA, CA Uday Swati at Sirsi, and many of you have contributed to my understanding of income tax law, even though it may be a small pinch in the whole ocean. Perhaps I have bothered Chythannya sir with so many times with so many silly questions. And he has been so patient, he has been such a loving personality that anytime I call him up, anytime I speak to him, he has guided me just like anybody would guide the younger brother. I'm very grateful to you for all his guidance over the years. Sir, Padam sir, I met him in 1998. Perhaps I may forget the dates. I'm sure Padam sir and Chythannya sir will never forget the dates, sections, clauses, provisos, and explanations. All of you know that by now. I met Padam sir in 1998 at a seminar at Hubli and got so impressed. That was the time I hardly had any idea about income tax. I came from a farmer's family, and my parents never wanted me to become a chartered accountant. They wanted me to be an advocate at the most, or to stay back in the village taking care of the betel nut plantation. At a point in time, I had to borrow 1,300 rupees for enrollment for my articleship, and I decided to pursue CA articleship along with my law education, and I had to manage both. I cannot forget the institute which refunded that 1,300 rupees on its own for the reason that I was standing second to the university while I was doing BCom. On its own, they wrote back to me that you are eligible for a refund. And I'm really grateful to you for the institute, for the encouragement I got from the institute for all these years, and also the present committee, past several committees. The other day, I was referring to the Sampath Iyengar's commentaries updated by Padam sir and Chythannya sir. For a while I thought perhaps for the several silly questions we keep on calling both the sirs, they decided to take up the responsibility of updating 12 volumes of Sampath Iyengar, and with that many of my calls to Chythannya sir got reduced, and perhaps he could focus more on his clients. Such a marathon task, such a humongous task they have taken up, and such a great contribution to the whole body of professionals they have rendered. If I have to become successful, many a times I feel I should reach at least 10% of the heights they have tried to reach, and it is my endeavor to do so. When the chairman of the branch approached me whether I can come for the felicitation, I had a hesitation in my mind whether I am really eligible for that, because it's only a namesake I'm standing here. It is the efforts and contributions of many of the gurus and professionals and not myself. But when Padam sir and Chythannya sir, I came to know they would be here, I thought I should make it, and this felicitation is making me much more responsible and more commitment towards the profession, and also more commitment to the job that I need to take up. This for me is just a beginning of a new journey, and I'm thankful to you for giving me an opportunity to come here. Perhaps I'll forget in my duty if I don't mention some of the people who helped me in my profession. This is a great opportunity for me to share the names of those people and thank all of them. It's C.A. Sri Krishna Kelkar from Belgaum. It's CA Narayan Bhatt, his son Shripad, who is a part of the committee here, CA Pramod Hegde, his father CA Ramohan Hegde, CA Shuram Bhatt, who was chairman of the branch earlier, and also I should thank the KCAA, which gave me a lot of opportunities to share my thoughts, and also the branch for giving me many opportunities to participate in many of their seminars. I take this opportunity to thank all of you once again.
Thank you, Prakash Hegde. Members, I think it is really an embarrassing moment, a humble moment for all of us. His humble words and the recognition of his past contributors for his growth really matters a lot. With this, before we break, we are going to break for a tea. I request, and there is an announcement for all of the members. We have Agrawal Eye Hospital who is helping us with the free eye checkups. You can, that is arranged at the right side of my right side, at the below grounds. And we also have taxmen who are offering us 30% discount this day. Please take benefit of this. Thank you, sir. We'll all break for the tea and reassemble after just 10 to 15 minutes. Thank you.
I'm conscious of the time, therefore I will give a very brief introduction of Section 9, and we will go into certain aspects of Section 9 where we find material changes from the 61 Act to the 2025 Act. What is the function or role of Section 9? It says incomes deemed to accrue or arise in India. It changes the locale where the income, if it's accruing in a particular jurisdiction or a particular place, Section 9 shifts that location, says it is deemed to accrue or arise in India. Therefore, the function of Section 9 is concerning the place of accrual of income. It doesn't concern about the timing of accrual. It doesn't concern with the factum of accrual. It doesn't concern with the person to whom the income accrues. It's extremely important for us to bear this in mind, that the function or role of Section 9 is to shift the place of income and say, therefore, that if an item falls within Section 9, it shall be deemed to accrue or arise in this country. We are used to the Section 9, but we will find certain changes which have been now introduced in the 2025 Act, and therefore it will be worth going through all of this concern. What's important for us to bear in mind is, when looking to the 61 Act today, when we have particular items, we are familiar with the concept of a business connection, we are familiar with the concept of an SEP, we are familiar with the concept of a dependent agent permanent establishment that is there in explanations. We have therefore certain explanations introduced and certain definitions introduced. But as far as business connection was concerned, Section 9 dealt with the aspect of attribution of income. It did not define business connection. It only said income from operations in India shall be the quantifying limitation for how much of business income is to be taxed in India. Therefore, explanation 1A was concerned with the quantification of income. All the explanation that fell thereafter, that there shall be no attribution of income if you are engaged in the aspect of purchase for the purpose of export. There shall be no attribution of income for a shooting of movie in this country. So if you look into those clauses very carefully, they were concerned with the factum of attribution of income in business connection and the various other situations concerned. They were not concerned with actual definition of business connection. We had a definition of SEP, which came a little later. But today, in the 61 Act, the format is given a go-by. We are now having in the 2025 Act a definition of a business connection. Therefore, it becomes important for us to understand the ramifications of the definition as given. It may be a little technical when Chythannya explains to you the outline of the section concerned, but it's important for us to be mindful of the fact that we have had certain definitions introduced into this 25 Act, which may have a material bearing on the understanding of the implications and import of particular situations provided therefore. It's also important to bear in mind the aspect of a dependent agent permanent establishment, a DAPE. We are having a situation when we borrow the concept of the treaties where we have the independent agent and a dependent agent. There's a possibility of a dependent agent giving rise to a permanent establishment. That concept is imported in a little more elaborate manner as far as the Income Tax Act is concerned. Explanation 2 deals with those circumstances under which a person acting on behalf of a non-resident can lead to a taxable presence for the non-resident concerned. So there were certain limitations under the 1961 Act as to under what circumstances, because of a person in India acting on behalf of the non-resident, which are the circumstances which will lead to the projection of the non-resident in India. What actions of the resident of the person in India can therefore translate to a taxable presence of a non-resident in India. In that context, therefore, we have had certain changes, subtle changes now in the 2025 Act. It's worth, therefore, bearing in mind the fact that when we understand the current explanation under the Income Tax Act and look into what is now sought to be provided for in the 2025 Act, if we were to go into the details in a very technical manner, it's a far significant expansion of the scope of what is going to be charged to tax for a non-resident in this country. And therefore, be mindful of this fact as to what happens when a dependent agent in India is acting on behalf of a non-resident concern. We also have the aspect of interest, royalty, and fees for technical services. 915, 916, 917. Lastly, the same. We are now retaining the concept of what are the circumstances under which a resident paying to a non-resident concern is by default deemed to accrue or arise in India if it is of the nature of interest, royalty, and fees for technical services. By default, payer being a resident of interest, royalty, and fees for technical services, it shall be deemed to accrue or arise in India. When a non-resident pays to another non-resident, by default it's going to be exempt, by exception becomes taxable. Those are situations provided for in 915, 916, and 917 main body itself. Now when you look into the existing provisions of the Act and look into a small change that has happened, particularly in relation to fees for technical services, what are the circumstances under which the fees for technical services will now get excluded even though the payment is originating from a resident? What are the circumstances under which a non-resident making a FTS payment to another non-resident, what are the circumstances under which these shall now be included with the total income chargeable to tax in this country concerned? It will be a case where you'll have to be mindful of the language concerned. And interestingly, when the language is consistent between 916 and 917 largely, we've had a small change in the language between 916 and 917. Therefore, we'll have an occasion to refer to the impact of the small change in the language, whether it's giving rise to some benefit to us or not. That will be an important point for us to be talking about. It's also important for us to be sure about certain change in the setup itself. For example, we had through or from a property in India, through a source of income, through or from a source of income, through or from a business connection, and through a capital asset in India. We didn't have through or from a capital asset in India. We're now having a change in the new law which says even in relation to capital asset, it shall be through or from a capital asset situated in India. May not have very significant ramifications, but it's important for us to notice the change concerned that the word all 4 or 5 items that are listed out as incomes deemed to accrue in this country have now a preceding qualification, common qualification, which talks about through or from the following. We are all concerned with software royalty. What happens in software royalty? Granting of license, including so and so. Transfer of all or right to use a software. There are certain changes made in relation to the software royalty aspect particularly. Whether it will have a really meaningful impact in relation to the incomes deemed to accrue or rise in this country, we'll have an occasion to look into that. Because we have had the Supreme Court decision in engineering analysis case, and we have had certain changes to the double taxation avoidance agreement by new articles coming into the picture there. We have not moved in the line of the engineering analysis overcoming those provisions concerned, nor have we moved into the new gamut of the clause that is there in the double taxation avoidance agreement. We are introducing our own language in 916 as to what will be the circumstances under which the royalty shall be deemed to accrue or arise in India from out of a software licensing. Therefore, these are certain changes that we have to be talking about. And we therefore also have to keep in mind that Section 9 in the opening portion is not drawing a distinction between a resident and a non-resident. So only in the clauses concerned internally that you have a situation highlighted as qualifying only a non-resident concern under particular circumstances. But by virtue of its setting itself, it does not draw a distinction between a resident or a non-resident. If you look into the Section 9 setting by itself on an overall basis, it's applicable to both a resident as also a non-resident. With this background, we will get into Chythannya detailing to us the ramifications of the finer points of what I've made a mention about and some other points that I think are worth discussing.
Section 9 again on the face of it has not seen much of a change. But then when you would get deeper into it, you will find 3 or 4 material changes. Considering that you will have to spend significant amount of time later on transition provision, because you are moving from 61 Act to 2025 Act, there will be a lot of legacy issues. Going forward, how the same will have to be handled. We have to spend a good amount of time on legacy provisions and the transition provisions a little later. Therefore, I would try to focus only on those aspects of Section 9 which would have material impact in terms of the taxation of the non-resident. And before we get into the nitty-gritty of Section 9, the scope of Section 9 has to be very carefully understood and the limitation which the Section 9 has. Section 9 does not deal with the time of accrual. It does not deal with the accrual as such. It doesn't make a non-income an income. Its role is confined to fixing the locale of the income, that's all, by an artificial fiction. For Section 9 to kickstart or come into play, the income as such has to exist. And that income shall have accrued at any place. Then Section 9, in the specified circumstances, would deem the locale of the income or the situs of the income, which is otherwise outside India, to be in India, that's all. Whereby, in terms of Section 5.1b and 5.2b, what is otherwise an income that accrues or arises outside India is deemed to accrue or arise in India, and hence would become part of scope of total income. See, present Section 9 is little complexly structured, in as much as you will have the subsection 1 with too many clauses, and under each clause you will have explanation. Then under each explanation you have the provisos. Like for example, if you look at 9.1.1, which deals with the generic business connection, then you have explanation 1, which will deal with attribution aspect, where there's an exemption from attribution in some specified cases. You'll have explanation 2, which will deal with agency business connection. You will have explanation 2, capital A, which deal with significant economic presence. You will have explanation 3A, which will deal with additional attribution in respect of advertisement and data, sale proceeds, income, etc. So you will have very complex situation. Then you have other clauses coming in, 9.1.2 dealing with salary, 9.1.3 dealing with salary, 9.1.4 dealing with dividend. Then you will have 9.1.5 interest, 9.1.6 royalty, 9.1.7 FTS, and 9.1.8 is the gift of money to a non-resident or a not ordinary resident. Then you will have an overarching explanation, which is brought in after the decision of Supreme Court in Ishika, Wajima, Rima, Heavy Industries 288, ITA 408, where the Honorable Supreme Court said and brought in some sort of a territorial nexus requirement even for FTS income, to say that FTS income would be charged to tax only when it is rendered in India as well as when it is utilized in India, for which reason they had to bring an explanation twice over. 2007 they tried to bring an explanation. Karnataka High Court said nothing can happen because this explanation, they virtually said the explanation is useless. Then they brought in another explanation in 2010. So it's structured very complexly, this particular section 9. That way they reorganized section 9 very well. And they've also made sure that, when we transition from old act to new act, we shouldn't get too much confused. So 915 has become 95. So 916 has become 96. So 917 has become 97, 918 has become 98. So at least those 4 streams of income, it will match in terms of the number of subsection in the new act and the number of clause in the old act. There are some redundant provisions which at this point in time will not get into. Now we'll move into some material changes. I'll go to 911 a little later, apart from what Mr. Padam mentioned, that insofar as income from capital gain is concerned, they have used the word through or from the transfer of a capital asset in India. And the through is defined in a very, very wide manner post Vodafone decision in 341 ITR1 2012 amendment. Now let's look, I'll come to those aspects a little later of the agency business connection, the attribution aspect. So let me deal with the simpler aspects first. When you would go to section 9.6, which corresponds to 916, we deal with taxation of royalty. See, basic premise upon which the royalties chart to tax has not changed. Meaning, if the payer is government, in the hands of recipient, it's always chart to tax. If the payer is a resident, in the hands of the recipient, non-resident, it would be by default chart to tax, except where the paying resident uses the property for which he pays royalty or utilizes the services for which he pays royalty for the purpose of his business or profession which he carries on outside India, or for the purpose of earning or making any income from any source of income situated outside India. This is just the same. And when the payer is a non-resident, you have a situation of one non-resident making payment to another non-resident. By default, it is not chart to tax in the hands of the recipient non-resident. By exception, it is chart to tax. What is the exception? When the paying non-resident utilizes the property or the service for which he is making payment of interest, royalty, or FTS for the purpose of his business or profession in India, or for the purpose of earning or making any income from any source of income situated in India. So this is how it is structured. There is not much of a change insofar as 9.6 is concerned, which deals with the royalty taxation, except that as they define royalty in 9.6b, see, royalty is defined in explanation 2 to 916 of 1961 Act. You have clauses 1 to 6. All have been captured with one change. Transfer of all or any rights, within brackets, including grant of license, close brackets, in respect of any patent, invention, model, design, know-how, secret formula, process, or any other similar property. This is how presently it is structured. Transfer of all or any rights, open brackets, including granting of a license. Now they have used an additional word, transfer of all or grant of any rights. And again, open brackets, including grant of a license. So we struggled a bit to figure out as to would it expand the scope or not. We also went into the Copyright Act and the Patents Act and Trademarks Act. We couldn't fathom out as to what extra burden it would cause on us by using this word grant of in place of transfer of. So therefore, there is some change. The impact of the change as of now in our limited wisdom is not discernible. So we have stopped working on that. We think that there is not much of a change because of use of these additional words, grant of. Now, see, the guys in the department, they don't like monotony. What is simple, straight in the 1961 Act, as they move to 2025 Act, they would want to introduce some fun. And they choose which place to have this fun randomly. One is 9.1 7, which is FTS, corresponding provision 9(7). I was trying to tell you that when a resident pays to a non-resident, by default, it is the income of the recipient non-resident, correct? What is the exception? When the paying resident utilizes the services for which he pays royalty or FTS. Now, this change is made only in FTS. Utilizes services for which he pays FTS fees for the purpose of his business or profession outside India, or for the purposes of making or earning any income from a source of income outside India. So, what is the phrase used? For the purposes of. For the purposes of. This is how it was used in 61 Act for 916, 915, 916, 917. They used the same phrase in 95 for interest, 96 for royalty, but when it comes to FTS, they would not use the phrase for the purposes of. They use the phrase for. Now, it's not for the purposes of business or profession carried out by him outside India. It's for the business or profession carried out by him outside India. You may wonder, what is the difference between for versus for the purposes of? For business is broader, or for the purposes of business is broader. So, what's your take? What's your take? You go by your intelligence or artificial intelligence? The artificial intelligence says for business is wider than for the purposes of business. So, to that extent, it could enhance the scope or reduce the scope depending on who is paying. Meaning, if a resident is paying to a non-resident and if he utilizes the services for his business outside India, which is wider than for the purposes of business outside India, even situations where infructuous expenses, etc., which otherwise couldn't have possibly fallen within the meaning of for the purposes of, could now fall by using the broader term for business. And hence it stays outside the scope. This is so far as when a resident pays to a non-resident. The reverse would happen when a non-resident pays to a non-resident, because by default it is not to be charged to tax in the hands of the recipient non-resident. By exception, it is charged to tax. And what are the exception? When the paying non-resident uses it for his business in India. So, this is how it could make a change in terms of scope. To what extent it does change the scope will depend on your interpretation of what would not fall within for the purposes of, but would fall within for the business. This is how it has to be looked at. Anyway, we will move on now. This is in respect to FTS. Now, we will go into agency business connection. Those who have dealt with the agency business connection, which is couched in the form of explanation 2 with 2 provisos thereunder under section 911 of 1961 Act. What it conveys, if the business of the non-resident is carried out through a dependent agent, who is a dependent agent? Who is not an independent agent? Who is an independent agent? Whose activities are not solely devoted to the principal non-resident. He is not the one who controls the non-resident, nor is he the one who is controlled by the non-resident, or he and non-resident are controlled by a common controller. These are situations of determining when your agent is an independent agent, a dependent agent. The definition of independent agent, dependent agent, they have not changed. They remain the same. But then, what was coming as explanation 2 with 2 provisos have now been restructured into clauses. So, it was a case of an explanation and a proviso being converted into subclause. This is what Mr. Padam was mentioning in his introductory talk as to what repercussions you would have when you recklessly convert the explanation and the proviso into subsection. This is a classic case. Now, all this have now been put in 3 subclauses, 99A, 99B, clauses 1 and 2, and 99C, clause 1. The way they have gone about restructuring it would significantly enhance the scope of a non-resident. How? I'll explain. Presently, when a dependent agent carries out one or more of 3 prohibited activities, he would trigger a business connection for a non-resident. I'll repeat again, when a dependent agent, who is a dependent agent, who is an independent agent, I would not get into it because there's no change. You can refer to the provisions, no change there, and get to know. But then when does a dependent agent trigger a business connection for the principal non-resident? Not simply because he's a dependent agent. First he has to be a dependent agent, then he has to carry out one or more of the 3 prohibited activities. What are these 3 prohibited activities? 1, where he has authority and he exercises an authority to conclude the contract on behalf of the non-resident, or he actually concludes the contract, or he plays the principal role in concluding contract for the non-resident. This is prohibited activity number 1. Prohibited activity number 2 is where he holds stocks for the non-resident from which he regularly delivers stocks on behalf of the non-resident, meaning he is a stockist for a non-resident. Mike has started reacting to 2025 Act. You guys have been more generous. Third is where he habitually secures order for a non-resident, wholly or almost wholly for a non-resident. 3 activities. You conclude contract for a non-resident, you hold stocks and make deliveries on behalf of non-resident, you secure habitually orders for non-resident or almost wholly for or mainly for the non-resident. It's only when you carry out one or more of these prohibited activities you trigger a business connection for a non-resident. This is a well settled rule. This is almost analogous to the DAPE, Dependent Agency Permanent Establishment, which we have in Article 5 of the Double Taxation Avoidance Agreements with many jurisdictions. Now, as they restructured it, the post-restructuring, without realizing the impact, converting this explanation 2 and provisos into subsections would now mean what? The moment you are a dependent agent, whether you carry out prohibited activities or not, you trigger business connection for the non-resident. Meaning, you don't have to necessarily carry out one or more of those prohibited activities. The fact that you are a dependent agent will trigger a business connection for the non-resident. This would be significant tax impact. This would have significant tax impact for the non-resident. Unintended, but this is the result of restructuring. So you'll have to be extremely careful here and wherever possible bring it to their knowledge to carry out necessary amendments because this is completely unintended. Even under the DTAA, if you are a dependent agent, that would not trigger PE for you unless and until you carry out the prohibited activities. So this is a very important change that has taken place here. How it translates into this kind of a meaning, I will not demonstrate. I've just explained to you what it is. You please go through section 99A, B, clauses 1 and 2, and 99C. And together when you read these carefully, you will get this impression. when it comes to attribution, explanation 1, explanation 3, explanation 3A to section 9.1 deals with attribution. See, once there is a business connection, it is not that whole of non-residents' income is to be charged to tax. There is a requirement of attribution, meaning where not all operations of the non-resident are carried out in India, the income that is required to be attributed would be only so much as may be reasonably attributed to the operations that are carried out in India. Because end of the day, we have the territorial nexus theory. In order that we tax a non-resident, there has to be a nexus with the Indian territory. So therefore, when there is a business connection, the nexus is established on the basis of operations that are performed in India. When they found that it is not just the physical presence, but it's also the virtual presence that would enable a non-resident to earn significant income without having to pay tax in India, then they brought in something called explanation 2 capital A, significant economic presence. See, typically what earlier was taxed was income from business in India, not income from business with India. So there's a difference between income from business in India, where you come into Indian soil, carry out the operations. Only that was earlier sought to be taxed. Later on, they started taxing even business with India, whereby they brought in the concept of significant economic presence, and they fixed a threshold, and if your dealings with Indians would cross the threshold, then you shall be deemed to have significant economic presence. In turn, you shall be deemed to have business connection that would require attribution of income. So attribution is dealt with. Now, as they deal with attribution, they have made some errors in as much as, please look at this, 99F, if you're able to see this. In this section, only income which is reasonably attributable to clause 1, operations carried out in India when all operations of the business are not carried out. Meaning what? Typical business connection. Some operations are outside, some operations are inside. You tax the non-resident only to the extent income is reasonably attributable to operations inside. That is clear. It is presently dealt with under explanation 1, clause A. Transactions of purchase, sale, services with persons in India exceeding a particular threshold, or you had interaction with the users in India exceeding a threshold of number of users, then it would trigger significant economic presence. But then there is an exception in clause E, which says that if these are confined to purchase of goods in India for the purpose of export outside India, then that would not trigger significant economic presence. This is to encourage the export activity, where you do all this only for the purpose of purchase of goods in India and you ship those goods outside India. Don't do anything else. That would encourage export here. Therefore, they would not want the non-residents to suffer tax here. So that is coming in clause E. But when the attribution is made, look at this, transaction or activities referred to in clause D, they should have said not those which are covered by clause E. That is missing here. They should have read clause D subject to clause E, because clause E will give you an exemption. Now, because there is no cross-reference in clause D to clause E here, though there is an exemption under clause E, whereby your activities of purchase wholly meant for export wouldn't have triggered significant economic presence, but because their activities falling under clause D and reference is only made to clause D, you will not get the benefit of exemption. This is a problem that is created by not linking the clauses properly. Now, There's an interesting thing again. This is a goof up which favors the taxpayers. They are not happy with the income attributed to operations in India. They realize that without operations in India, non-residents using India are making hell a lot of money. They identified 3 such things. One is where you derive income from advertisement which will target the Indian audience. 2, in the course of business, in the course of interaction with Indians, you would have collected a lot of data from them, which data you would have taken to your jurisdiction, would have processed it, and would have made it a sellable commodity, would sell the data, and then realize huge gain. For example, like Amazon, or any, like overseas e-commerce operators, you would be dealing with them, Uber, Amazon, lot of data which would get collected subject to data privacy legislations in India, would get collected, would get processed. When you use the Google map, they would know your taste, which places you stop for a break. All the data which will then get gathered in an overseas jurisdiction, get collected, get processed, and get sold for a huge, handsome price that they would want a portion of it to suffer tax here. Thirdly, using the data, if you sell goods to people in India, that also is sought to be charged to tax here. So these 3 streams of income are sought to be charged to tax, which essentially do not relate to operations in India, but would have some nexus with India in terms of advertisement targeting Indian audience, sale of data collected from Indians, and sale of goods to Indians using the data that is so collected. So some nexus is brought in, because in GVK Industries case, 332 ITR 130, the Honorable Supreme Court, the Constitution bench stated that it is enough if there is a territorial nexus. We are not looking at the sufficiency or adequacy of the territorial nexus. So some nexus has been brought in here so that they justify the taxation. As they did that, now how they wanted to do it, they wanted to bring all these into tax in India in terms of 1961 Act Explanation 3A, that is now coming as a separate clause 99G, but the language used is, like look at this, income attributable to operations of any business or SEP shall also include income from ABC. Does it serve any purpose? What they should have stated is, income attributable to operations of any business in the case of a business connection in India which is deemed to accrue or arise in India will include ABC. Or they should have stated, income attributable to SEP in India shall include income from these. Income that is deemed to accrue or arise. They have not stated it. They only stated that income attributable to business will be this, income attributable to SEP would be this. We are not concerned with income attributable to business. We are not concerned with income attributable to SEP. We are concerned with income that is deemed to accrue or arise in India as a result of SEP in India. When they made it as a separate clause, they should have taken adequate care to state that the following incomes also shall be deemed to accrue or arise in India. Where are the words? Those words are missing. Earlier, these words would have mattered. The absence of these words would not have mattered, because all these came as explanation and proviso to main body. So one would have read all this together. Now you are reading this as an independent clause. Now I would argue, from this clause, how are they able to tax me? What they can tax me is the income that is deemed to accrue or arise in India. Now can you see those words in this clause here? You don't see those words in the clause. Therefore, I would now want to argue that whole of this clause G is OTOs. It doesn't take us anywhere. It is nugatory. So this is the problem in the way they have gone about drafting it. So with this, these are some major issues that related to section 9. Now we will go into another issue which is of immediate importance to us, is the transition issue, which is section 536. Mr. Padam would explain you the basic background of this particular provision as we go into different clauses later on.
In our tax life, quite a number of things are ongoing. We are going to have a break now on 1st of April 2026. saying that the new act will come into picture. 536 is dealing with the transition provisions and also repeal provisions. And subsection 1 of 536 says, Income Tax Act 1961 is hereby repealed. Technically, therefore, Act should have no other existence or no purpose after 1/4/2026. That would cause a lot of problems for all of us. Therefore, they have some saving provisions. They will make the law applicable, the 61 Act, to certain proceedings even beyond 2026. What did the 1961 Act do when you had a transition from 1922 Act to 1961 Act? 297 of the Income Tax Act 61 had certain situations being dealt with there. So when you had therefore a transition from 61 to a 61 Act from the 22 Act, when you are filing a return for assessment year ending on 31st of March 1960, for example, you had two situations. You filed that return prior to 1/4/62, or you filed a return for that year after 1/4/1962. Because 1/4/62 was the date where Income Tax Act 61 came into picture. How do you deal with that? When you file a return of income prior to 1st of April 62, how do you deal with a return filed after 1/4/62, both returns relating to the same assessment year for two different assessors concerned? 61 Act, that 297 said, old Act will apply to all returns filed up to 1/4/1961. New Act will apply to all returns filed after 1/4/1962. So we didn't bother about the assessment year. We bothered about the date of filing the return of income. This was the normal provision. All returns, for example, therefore, March 60, depending on the date of filing the return, it may be governed by the old law, it may be governed by the new law. They had a specific provision in relation to a notice for reassessment. They said, even though a notice may relate to an earlier year, but it is issued after 1/4/1962, the reassessment proceedings, if the notice is issued after 1/4/1962, will be governed by the new provisions of the Act. So we had therefore a small exception or a small deviation for reassessments. What is the 2025 Act tells us? It's extremely important, therefore. We are therefore to imagine a lot of situations that are ongoing. I have to file a return of income. I may have filed before 26, I may file after 26, which year it pertains to. Having filed, assessment has to happen. What will be the law that will govern the assessment? If I filed a return prior to 26, what will happen to the return if it's picked up for scrutiny post 1/4/26? If that scrutiny had commenced prior to 25 and the assessment is completed after 26, if there is a penalty to be levied because of the fault committed by you, there are 110 types of penalty, which will be the law applicable for the levy of a penalty? So we have therefore a lot of ongoing proceedings, and we therefore have situations of revision, rectifications, reassessments, recomputations. So we therefore have to be concerned about what happens when the law changes from 1/4/26, and a lot of these situations are dealt with by subsection 2 of 536. There are in fact 22 such situations dealt with. What are the situations largely concerning? We are having a situation where there's an impact across the years concerned. One which is very easy for us to understand would be loss incurred and accruing to me up to 31st of March 26. What will happen to that loss? Which will be the law governing that loss when it goes beyond 31/3/2026? It's a very normal, natural situation. How is that provided for? Is one way of looking at things. There could be situations where, for example, amalgamation has happened. Amalgamation can happen prior to 26. The laws will go to the new company and survive for it being allowed in some particular manner. Amalgamation may happen with the losses incurred prior to 26. Amalgamation may happen after 1/4/26. Therefore, you may have a situation, therefore, those laws that were referable to prior to 26, how would the new company deal with those losses when amalgamation happens after 1/4/26? How would that company deal with losses concerned? So these, for example, amalgamation is dealt with by 116 of the new Act. Unabsorbed depreciation is dealt with by section 33 of the new Act. We have to therefore be mindful of what is provided for in section 536 and what is the way in which 116 or 33 will have an interplay when we have these sections being read together. What will be the impact in case of a demerger, in case of an amalgamation, somebody else's loss going into the hands of another person concerned. I may have refunds, I may have payables, as a result of which I may be either entitled to interest, I may be liable to pay interest. So what will happen if there is a proceeding up to a particular March, 31st March 26, and thereafter the proceedings to continue? Do I pay interest under the old law? Do I pay interest under the new law? If I'm entitled to a refund up to that date, will there be a particular rate of interest? Will there be a particular rate of interest after the new law is coming into picture? So you have to imagine this number of situations, and therefore you have an occasion to go through all of that. There are particular options you are exercising. Under the law, there will be so many options you are exercising. Is 115 BSE an option, or is it a default regime? Is it a default regime? Is it an option? You have to ask this question concerned. When they say, hey, an option exercised by you under the old law, will it therefore be surviving under the new law? You have to ask the question, under what circumstances a particular act of an SSC is an option, or 115 BSE is a default regime. There's no question of option being exercised by you. You necessarily have to continue with that law because 115 BSE is a default regime. So to be therefore mindful of these situations where there is a particular option available to you or there is a new scheme available to you, there could be a situation where the law may have a particular deeming fiction concern, not giving you an option, it may be by default applicable to you. You may have an exemption being availed under the old law. There could be a violation under the new law. What will happen when an exemption is availed under the old law? What happens when there is a violation of those conditions under the new law? So you have to be therefore talking about these aspects. You may have the alternate minimum tax being carried forward, MAT tax being carried forward. Will you be entitled to those credits under the new law? So these are various situations covered under subclauses of 536. We therefore have to be concerned about the language that is employed in these clauses concerned, and we therefore have to be looking at the law as defined. There is a generic section which says any right, obligation, liability that you have incurred under the old law will continue to survive. That's the general law. See, what 536 subsection 4 is saying is, this repeal will have to be read along with section 6 of the General Clauses Act. Section 536 subsection 4 says, when you are looking at this aspect of repeal, you have to be mindful of section 6 of the General Clauses Act. And what does it say therefore? Largely it says, any right, obligation, liability incurred by or accrued in your favor will continue to survive despite the repeal of a particular enactment. What happens is when we are making a statement of referring to a particular tax year, it may have a repercussion for years prior to 31st March 2026. When you use the word tax year, but it refers to something else in an earlier year, how will you go about it? Take the case of a block period. There could be many situations concerned that a search has happened in the case of an SSC in, let us say, March 2026. It continues and ends thereafter concerned. How do you go about with the block year? When you look at the block year, how will the 6 years comprise of? Some of the new years, some of the old years. Some prior to the 61 Act, some going into the 2025 Act. How are you going to deal with those situations concerned? A search happens after March 26. How is the block year going to be computed? So these are very many situations that have been explicitly dealt with. And there is 536 subsection 3, which says that there is, wherever you have a reference to a tax year under the new law, but it has a reference or an implication or a repercussion in relation to a year prior to 2025 or 2026 March, you will have to therefore read that reference to a tax year as referable to the previous year as contained in the 1961 law. So the aspect, therefore, how will the new law come into picture. How will the old law, are you now getting rid of the old law? Are you supposed to therefore forget the old law immediately on 26? Or will the old law continue to survive? If it continues to survive, we'll have some examples dealing with as to how, in what manner it will continue to survive. And those are therefore points worth discussing. Chythannya will take us through 22 illustrations of 536 subsection 2. And they are worth going through. They broadly deal with those aspects I mentioned about, refunds, penalty, losses. These are all dealing with those particular provisions concerned. But you'll have an occasion to go through these 22 clauses concerned and understand. Before we go into these 22 clauses, we also have to understand broadly what happens to the 61 Act after 1/4/2026, and how do we go about understanding the transition? Because what is happening now in this 2025 Act is materially different from what happened in Section 297 of the Income Tax Act 1961. Therefore, are required to go into and understand this, make a study of 297, compare that with 536, see how there is a language change, or is there a borrowing of the same clauses into the new Act. Make a study of these two enactments, and then, by virtue of the explicit provisions concerned now, we'll therefore have a study of various situations that 536 subsection 2 is covering. So, over to Chythannya.
One good part of 2025 Act is that it gave most of us an opportunity to look at the transition provisions, which otherwise, as we practiced 1961 Act and came into practice much later beyond 1961, we hardly had occasion to refer to 297 of the 1961 Act. Except in very rare cases, like for example, we are arguing a notice under 148 issued prior to 31st March of 2021, but it continues post the regime change. 1/4/2021, they changed the law relating to reassessment. They brought in the concept of 148A, where they codified what JK and Driveshaft's case of Supreme Court stated. For those purposes, we would have referred to 297 to argue that those notices that were issued up to 31st March 2021, but still pending to be carried through and carried forward as of 1/4/2021, notices would lapse and they die. Unless and until they issue new notice, the changed set of sections relating to reassessment would not apply. For these very rare purposes, we would have referred to 297. This 2025 Act is given as a very unique opportunity to understand the struggle which one has to go through when he transitions from a repealed Act to a new Act. As Mr. Padam stated, this 536 has 4 subsections. Subsection 1 is straight and simple. Income Tax Act of 1961 is hereby repealed, but it is subject to subsection 3. And you will have subsection 3, which needs to be understood before we go to subsection 2. Subsection 2 will have 22 clauses from A to V, which will give exceptions to the repeal. See, normally what would happen when a statute is repealed, you forget about it. Subject to General Clauses Act, Section 6 of the General Clauses Act. A to V of subsection 2 would tell you, look, in these situations, you cannot understand repeal as you having to forget 1961 Act. These special situations have to be specially dealt with. Which are these special situations? Which we'll have to discuss in A to V, which I will go to those clauses a little later. First aspect is subsection 4, which deals with General Clauses Act. They are saying all those which are not covered above will be dealt with under General Clauses Act, which anyway would have been the case. Whether subsection 4 existed or not, General Clauses Act would have stepped in, unless there are contrary provisions, more particularly section 6 of the General Clauses Act. Now, for you to understand better the implications of clauses A to V, some of them overlap with section 6 of the General Clauses Act. it becomes important for you to understand the jurisprudence in interpretation of section 6 of the General Clauses Act. There are a lot of decisions which will deal with what is a right, what is a liability, what is an obligation. An inchoate right is not a right, an inchoate obligation is not an obligation. Now you will have a question as to a notice has come. Have you assumed any obligation? Unless and until an assessment order is passed and a demand notice has been raised, there is no crystallized liability on you. So these are some aspects. Your analysis of 536 would be incomplete unless you would also go through those decisions relating to section 6 of the General Clauses Act. This is insofar as subsection 4 is concerned. Subsection 2, as I've said, I'll go a little later. Now we'll look at subsection 3. This is extremely important. Subsection 3 is transitioning you from 61 Act to 2025 Act. What subsection 3 says is that where any reference is made in 2025 Act to any tax year which is 25, 26 and earlier, please hear me carefully. As you read 2025 Act, they refer to tax year. They don't refer to previous year and assessment year. They refer just to tax year. If the tax year were to relate to any period that is 25, 26 and earlier, then they would say it shall be construed as a reference to the relevant previous year under 1961 Act. It will be construed as a reference to the relevant previous year under 1961 Act. Now, this particular subsection is critical for your understanding of provisions of Income Tax Act of 2025. And this understanding of subsection 3 will have to be kept in mind by you as we go into specific circumstances of A to V in subsection 2. Now, we will look at how it will impact you. Take some cases, meaning of block period, which is now dealt with under 301 within brackets A, which is hitherto dealt with under 158B clause A of the 1961 Act. What is block period? The block period is defined under 301A of the 2025 Act as 6 tax years preceding the tax year in which the search has taken place, right? It's a block of 6 years, and it would also include the period up to the time when the search so initiated is executed. So 6 plus, what is block period now? 6 plus. 6 are the years, 6 tax years preceding the tax year of search, plus period up to the time the search not initiated, search is executed. What is execution of search? Last of the authorizations is executed by drawing the Panchanama. That is how the block period is defined. Now let us take the case of a search initiated on 5th of April of 2025. So which is the tax year? 2026. So which is the tax year? 26, 27 is the tax year in which the search has taken place. What it would consist of? 6 tax years prior to the tax year of search. Meaning you are traveling to which era? You are traveling to which era? 1961 era. Is there a reference to tax year in the 1961 Act? No. But this tax year, 6 tax years would then be 25, 26 and earlier. And you go to 1961 Act, you don't find the word tax year, therefore they would say, look, if these are 25, 26 and earlier, we will construe them as relevant previous years. So that is how they are sutured the old Act with the new Act. You can't say your block period would not include tax year of 1961 Act, because though they have said the tax year, it had to be construed as relevant previous year of 1961 Act. Is this clear? This is one example. Take another example of thin capitalization 94B. 30% of EBITDA is the maximum of interest that will be allowed under 94B. What is not allowed will be allowed to be carried forward to subsequent years. Now if you look at the present statute, it is dealt with by section 177 of the 2025 Act. What it would state, if any interest was not allowed in a preceding tax year, that would be allowed to be carried forward. Now, let us say you have the legacy deficit interest of 1961 Act. That would now have to be allowed to be carried forward or not. The new statute, section 177, does not refer to assessment year or previous year. It refers to tax year. Strictly understood, there was no tax year in 1961 Act, so there is no question of deficit of 1961 Act. It is always with reference to previous year or assessment year, but then this is a case where the tax period of 25-26 and earlier will have to be understood as previous year, and therefore, if you have had as of the cutoff date, that is 1/4/2026, any legacy deficit under 94B, you are allowed to be you are allowed to carry it forward to the new regime. This is the help of 536(3). I am just giving you some illustrations. Take the case of 80JJAA, which will give you the deduction of 30% of the wages paid to new workmen, subject to satisfying some conditions. And how much of deduction you get? 30%. How long you get? You get it for 3 years. Let us say the 3 years have not lapsed by the time you move into new act. So you will still have 1 or 2 years left. So the definition or the understanding of the tax year as is adumbrated in 536(3) would help you to continue to claim the deduction for the rest of the 3 years, even though you would have moved into the new regime. And next could be a case of section 294 of the Income Tax Act, which says if as of the first day of the assessment year, there is no Finance Act passed yet, there is no Finance Act passed yet, then till it is so passed, you could be charged to tax on the basis of either the existing law or the bill that is placed before the parliament, whichever is more favorable to the taxpayer. So, understanding of 536(3), that is now presently dealt with by section 530 of the 2025 Act. So, this would help you understand section 530 better and implement the same even in the year of transition. Now, take 2 more situations. You have 41(1). What is 41(1)? If in any previous year, an allowance had been made to you or a deduction has been allowed to you in respect of any expenditure or loss, but in a subsequent previous year, you receive any money in respect of such allowance or loss, or you get any benefit in respect thereof by reason of waiver or remission of a trading liability, then notwithstanding that in the subsequent year you have transferred the business to some successor, or notwithstanding that in the subsequent year you are continuing to carry on the said business or not, you would have to pay tax to the extent of some received or to the extent of waiver or remission that has taken place. This is what is called as 41(1), which is now dealt with under 38(1)(a). 38(1)(a) refers to tax year. Now, if in the past, one would have argued there is no tax year in the 1961 Act, so I was allowed only in respect of an assessment year in the previous year. So, if I get a benefit post enactment of new Act, I will not have to pay tax under 41(1). You can't take that argument because 536(3) addresses it very well. But it is not that in all situations, 536(3) would address. It depends on how the new section is structured. I will give an illustration of 38(1)(d), which corresponds to or which is analogous to 41(4) of the 1961 Act. What is 41(4)? Recovery of bad debt. If a bad debt is allowed as a deduction under 36(1)(7), if subsequently there is a recovery of the bad debt, then you will have to pay tax in respect thereof, right? Whereas 38(1)(d) of the 2025 Act deals with recovery of bad debt. There they don't refer to the word tax year. There is no reference to tax year in 38(1)(d). So therefore, you can now take an argument that 536(3) will not come to the rescue of the department. If the bad debt was allowed under old Act under 36(1)(7), and as you move into the new regime, you will have a recovery thereof, then the present 38(1)(d) will not trouble you at all. Don't go to make unnecessary provision entries or write-off entries as of 31st March of 2026. Don't get into tax planning mode on this. Otherwise, I know what you will do, like write off the bad debt as of 31/3/2026, because as is clarified by the circular, as also held by the Supreme Court, it is not necessary for you to establish that the debt has become bad. So write the bad debt as of 31st March of 2026, claim the benefit of 3617, move into the new act and do the recovery and don't pay tax. Is not a tax planning which I am understood to be explaining to you. I am only telling you don't do it. You got the message, I guess. So these are some of the provisions which would have to be kept in mind for you to better understand how the tax year will have to be understood if the tax year would relate to 25, 26 and the earlier years. Now we'll move on to subsection 2. Subsection 2 starts with the words irrespective of the repeal of the Income Tax Act and subject to subsection 3. Subsection 3 is what I have just now explained. Look at the language used, irrespective of the repeal. The Income Tax Department has thought, notwithstanding anything contained, is making Income Tax Act bulkier. They would have done the find and find function in the 1961 Act and would have computed how many words are contained in n number of notwithstanding used in the 1961 Act. If replaced with irrespective of, how many words would be reduced? But then they are not understood and done the homework, because even the difference between notwithstanding and irrespective of was dealt with by the Supreme Court, which has stated that notwithstanding would mean, let's say we say section X is notwithstanding anything contained in section Y. It would mean section X would override section Y only when there is a conflict, when there is repugnancy. Otherwise, both sections will have their play. When I say X is notwithstanding Y, both will survive, both will exist. But if there is a repugnancy, if there is a conflict, X will override Y. This is how notwithstanding is used. There is not much of a difference between notwithstanding anything contained or notwithstanding anything to the contrary contained. Both would essentially mean the same. Now, irrespective of would completely negate the referred provision. You don't have to wait for a conflict or repugnancy. Yes, Raghunatha's case, the Supreme Court says use of irrespective of would negate the provision completely. And at so many places, at all the places in the 2025 Act, they have used the word irrespective of. So it's extremely dangerous. Some cases it will benefit you, some cases it could work adversely to you. So which we will on a given occasion deal with those situations later. Now, look at various clauses, A to V. Clause A, nothing shall affect the previous operation of the repealed Income Tax Act, and orders or anything duly done or suffered thereunder. So whatever has taken place, so be it, it will remain. Nothing would, repeal would not allow the revival. Whatever is finished, finalized, would stay as such. So that is what is clause A. This is same as section 6 clause A of the General Clauses Act. To that extent, there is a complete overlap. They need not have had this at all. Now go to clause B. Nothing shall affect any right, privilege, obligation or liability acquired, accrued or incurred under the repealed Income Tax Act or orders under such repealed act. This also is almost same as section 6 clause B of the General Clauses Act. As I have said a little ago, it's important for you to understand what is the meaning of right, what is the meaning of a privilege, what is the meaning of an obligation or a liability acquired, accrued or incurred. They are not inchoate, they are not the pending proceedings, they are the completed proceedings, completed rights and obligations alone will survive, not the pending ones. But then we will not spend much time on this because this is just the same as General Clauses Act. This is an important clause. This, see, A and B, as I have said, are simple. C, is unique to 2025 Act, but then C is relatively general as compared to D to V. C will have to be understood as a default clause subject to D to V. Situations which are covered in D to V by applying the principle of generalia specialibus non derogant, you will have to apply those provisions. Where the situations are not so covered in D to V, then they have to be addressed under clause C. This has to be kept by you in your mind. Now, what does clause C say? Clause C says, provisions of the repealed Income Tax Act shall continue to apply to any proceeding pending on the date of commencement of this Act and to any proceedings initiated on or after 1st of April of 2026, including notices, assessments, reassessments, recomputation, rectification, penalty, reference, revision and appeals, brackets close. Now, hear me carefully. In respect of any tax year beginning before 1st of April 2026, and such proceedings shall be carried out as per the procedure specified in the repealed Income Tax Act. So, what is the first task for you to do? Identify the tax year. If the tax year is 25, 26 and earlier, if the tax year is 25, 26 and earlier, then whenever the proceeding may be initiated, whether it was already initiated, pending as of 1/4/2026, or may be initiated thereafter, we don't bother about when the proceeding is initiated, we are only concerned with which is the tax period, tax year. If the tax year is 25, 26 and earlier, you are going to apply what law? 1961 law. And as you would apply 1961 law, it is not just the procedural part, substantive part also. That's why look at the starting words. Provisions of the repealed act shall apply, shall continue to apply. They don't say what provisions, all provisions. All provisions of the old act shall apply, irrespective of repeal. And look at the ending words. Such proceedings shall be carried out as per the procedure specified. That means the upper portion of clause C deals with all the provisions including substantive provisions, and the ending portion of clause C deals with the procedural part. So, you don't have to delineate the provisions of 1961 as this is substantive, this is procedural, I would apply only procedural part, I will not apply substantive part or vice versa. You can't do that. The moment the tax year is 25, 26, the default rule is apply the old law. And as a measure of abundant caution, they put the bracketed words, notices, assessments, reassessments, recomputation, rectification, penalty, reference, revision and appeals. They are all inclusive provision. You cannot confine clause C only to these. So, only when you are covered by D to V, you don't have to worry about C. Otherwise, C is a default provision. Now, post 1/4/2026, for several years you will have the proceedings of old act for the period 25, 26 and prior could arise. Take for example, reassessment. The last of the previous year for the 1961 Act is 25, 26. Assessment year is 26, 27. And the maximum time that is available to reassess under present 148 read with 148A, read with 149 would be 5 years, 3 months for them to initiate notice under 148A. So, 5 years, 3 months would mean the end of assessment year. So, 25, 26, the assessment year is 26, 27, 5 years will be 31st March of 2032, another 3 months, 30th of June of 2032. Till then, 30th June of 2032, till then, you will have the old act continuing to remain. Even much thereafter, because after the notice is issued, then they are going to go ahead and do their assessment within the time limit of 153(2). There are 12 months from the end of the year in which the notice is issued to complete, and thereafter you will go in appeal. Thereafter, further appeals will take place. And for several decades, you will have 1961 Act remaining. See, this is what our Sampathayanga book, the release function in Delhi, we had called Justice Ujjwal Buyan from the Supreme Court. He stated in his concluding remark that this Sampathayanga, whether it is updated or not with the 2025 Act, it is going to be there because next 3 decades you will have the 1961 Act still being relevant. Take the case of updated return. You can file updated return within 4 years from the maximum within 4 years from the end of your relevant assessment year. So last assessment year under the old regime is 26-27. 4 years from there, 31st March of 2031, you will have to be filing the updated return. They'll have to keep the forms ready under old Act. And for the tax years from 26-27, they'll have to keep the forms ready under new Act. They are not realized the kind of difficulty they'll have to undergo as they will have to be administering 2 statutes. We are happy with that because let them make mistakes. So they are troubling us with this kind of a statute. So they'll have to be making mistakes. So we were jocularly, talking yesterday about the remands that would take place. Many a times the remands are big boons because post-remand the department would forget. The time limit would have lapsed under 153.3 or 153.5. Then we would say returned income would become the final income applying Shelley Products case. So this is how, it will come in handy even if the assessment is set aside and remanded. A department, considering the kind of workload they will have, they'll not be in a position to keep track of these. So these are some examples which will have to be kept in mind as you would, look at clause C. As I've said earlier, at the cost of repetition, this is a default clause. This would apply, whereby old provisions would continue to apply for 25-26, notwithstanding when the proceeding is initiated. There is some small problem here at places. I'll give an illustration of a search. In terms of clause V, 536(2), if the search is initiated on or before 31st March of 2026, Income Tax Act of 1961 would apply. If the search is initiated on or after 1/4/2026, the Income Tax Act of 2025 would apply. Now take a case where a search is initiated post 1/4/2026. Continuing with our example, let us say search has taken place in April of 2026. That is in the new Act. So in terms of clause V, what should apply? The new Act would apply. Under the new Act, you will have to capture the block period, which is 6 prior years. But those 6 prior years would fall into which regime? Old regime. Now, if you were to stay with clause C, because the tax periods would be the past 6 years, which will fall into old regime, which Act would have applied? Old law would have applied. But then clause V will act as an exception. As I said earlier, C is the default regime, the rest are all the special regimes. So clause V would say, hey, look, here is a case where the search is initiated post 1/4/2026, therefore what would apply? The new law. That means you will have new law that would apply even for the past period, an exception to clause C. Now, the problem that it would create is, the present block assessment will provide that as you take the block as one unit and would do a unified assessment for the entire block period, if any assessment is pending for one or more of these years, that would abate. There is a concept of abatement. Pending assessments would abate. Now the problem here is, you have a such taking place in April 2026. The 6 years would relate to 1961 Act. The new law would apply. Under the new law, they would say, what would abate are proceedings pending under new law. But for these 6 years, proceedings cannot be pending under new law. Proceedings would be pending under old law. Therefore, it would not abate. They are not realize the problem that is being created because of this kind of a thing. Now, we will have a situation of the officer under 1961 Act seeking to complete the proceedings because they are not abated. Income Tax Act of 1961 is repealed, and what is abated is what is pending under new law. So, no assessment up to 25, 26 would be pending under new law. So, there is not going to be an abatement under old law or under new law. You will have an assessment happening under old law as well as the block assessment happening under new law. So, we will have dual assessments taking place. When dual assessments would take place in respect of self-same income, then we would take a position what favors the assessee will have to be applied. Therefore, to that extent, the new law should not apply to you. So, this is a problem that is being created here in case of the search that would take place post 1/4/2026, but the one or more of the years of the block period would relate to 1961 Act. There is one more problem. Are you fine getting into this, or you would want me to move to other clauses? Because all complex clauses, one more aspect of this, I will merge it with clause V, because I already dealt with the search aspect here. See, clause V would say that if the search is initiated post 1/4/2026, new law would apply. They would go by the date of initiation. They have committed a mistake here, that they shouldn't have gone by date of initiation. They should have gone by date of execution of the search. So, there is a difference between initiation of search and execution of search. When is search initiated? When the warrant is issued, it is produced, and the action under 132(1) clauses 1 onwards would take place. That is when the search is initiated. When is search executed? When the last of the warrant is executed by drawing the Panchnama. The block period, as I have said earlier, would be 6 years, 6 past years, and when it would end? Not when the search is initiated. It would end when the search is executed. Now, take a case of a search initiated in March of 2026. Old law would apply or new law would apply? Clause V would not apply, because clause V would apply on the basis of initiation of search. Search is initiated under old regime. Old law would apply, correct? Old law would apply, but look at the block period. 25th March of 2026 search is initiated, but assume the party is so non-cooperative and highly complex that the search would go on and would take about 1.5 years in the new regime to be executed. So, at times search could go on for pretty long period, 6 months, 7 months, 8 months. It will spill over to the new regime. Then the block period will have a situation of past regime to some extent and new regime to some extent, but which law would apply? The old law would apply. This is a classic case of 1961 Act continuing to apply even in respect of sum of a income earned post 1/4/2026. That is because the cutoff is initiation, but the block period will go up to the time of execution, and there is a time intervention between the time when the search is initiated and time when the search is executed. So, this also would create some interesting issue. Now, we will move into next clause. Oh. We have another 10 minutes to go. I will try to cover some topics. I may have to skip the non-important ones, which are more of academic interest. Now, look at D, clause D. Actually, clause D is not required. It would deal with proceeding for imposition of penalty in respect of tax year 25, 26 and earlier will have to be imposed in accordance with the repealed Income Tax Act, as if the new act has not been enacted. So, this is already covered in clause C. except that it creates some problems because these words, as if this act has not been enacted, is not there in clause C. So then we would, people like us would start wondering, what is the function of these words? Would it make a difference? So they are unnecessarily creating a problem by carving out the penalty proceedings. Penalty proceedings are already covered in clause C otherwise, but now that they have made clause D, you will have to necessarily go by clause D. It should not make much of a difference. This again, any proceeding pending on the commencement of this act before an income tax authority or any other authority constituted under repealed act, tribunal or court, by way of application, appeal, reference, revision shall be continued and disposed of as if this act had not been enacted, which will mean the old act is not repealed, new act is not enacted. This is again the same as clause C, it's already subsumed into clause C. So we will not know why have they brought in these clauses unnecessary, and it will create some problems. Now, this is what Mr. Padam was mentioning. Any election declaration made or option exercised by you under the old regime shall be deemed to have been exercised in the new regime. What is this election made or declaration made or option exercised? You will have situation of cases like straight line depreciation or WDV depreciation if you are into generation of electricity or any other form of power. Is an election made by you or an option exercised by you, which you have exercised under old regime. It shall be deemed to have been exercised in the new regime and you will continue with that. 115 BAC, it would not apply election, declaration and option which would last within the very same year will not be hit by this unless and until it will have a continuing effect. Like 44 AD exercise option which you have exercised will have a continuing effect because once you have opted in, you are not expected to opt out for next 5 years. So 44 AD, 44 ADA, these are the ones which would come here. If it's a case of a simple choice, now the question that would arise is choice covered here? Is choice an option? To marry or not is an option. To marry whom is a choice. So both cannot be same. So thereby, if it is a case of a choice, you may argue if it suits you that the choice is not covered here and hence you may choose something else. If it does not suit you, you say choice is subsumed into option and hence argue that whatever option I have exercised is deemed to be exercised in the new regime. You would take a call depending on your convenience, keeping in mind the interests of the lawyers. Now, some examples which are covered, as I have said earlier, could be straight line on depreciation. You will have 11.1, explanation 1, where you can choose to postpone the application of income for charity. That's an option which you have exercised in the old regime, that would continue. 11.2, where you would have deferred application. And implications under 11.2 not being met with would be hit by 11.3, the corresponding provision in the new regime. So that would apply to you. And the choice, whatever you have made, will continue to bind you in the new regime. This is an interesting provision. Now, this is an exception to clause C. See, here is a case where proceeding would relate to tax year 25, 26 and earlier, but the refund would fall due in the new regime. It is not a case of refund that fell due in the old regime, but not at granted and granted to you later. Then you don't have to worry. You are covered by clause C. Are you with me? See, an assessment is completed, refund is already due, but they are known not to give you refund immediately. So they will sit on it. And eventually by some compulsion, they will have to give you the refund much later in the new regime. That is not covered here. You continue to get the benefit of 244A interest, 244A 1-year interest under the old regime in terms of clause C. This would apply to a situation where while the tax period is 25, 26 and earlier, the interest will become due to you now. Assessment being completed, 143(1) return being processed now, it becomes due to you now. When it becomes so due to you now, what are they trying to say? Provisions of this Act relating to interest payable by the central government on refund and interest payable by the assessee for default shall apply for the period after the commencement of this Act. Now, refund eligibility would be from what date? It depends on what is the refund composed of. If the refund is composed of TDS, advance tax, TCS, then it is due from first day of the assessment year. Refund is now crystallized in the new regime. Then they say for the period from 1st of April, the refund provisions of the new Act would apply, although it would relate to the past tax period, an exception to clause C. But it is silent on what has to be done up to 31st March of 2026. Department may say it is repealed and exceptions are not made. What is made here is only clause G, which is applicable for the period from 1st of April onwards, of 2026 onwards. Can the department refuse to grant you interest in respect of refund that becomes due to you now, but relating to the period prior to 31st March of 2026? If they would refuse to give interest to you under 244A up till 31st March of 2026, then you demand 12% interest under first principles. The courts have stated that Gujarat Floro, the larger bench decision of the Honorable Supreme Court, authored by Justice H.L. Dattu, has stated that when there is a specific provision in the Income Tax Act dealing with grant of interest, we'll have to go by that provision. It's only when there is no such provision, we can apply the common law principle. So, existing provision grants only 6%. If they refuse to grant me interest, then I'll go by common law principle and demand the interest at the parity of 12% because they charge me 12% under 234 ABC, is how we'll have to possibly argue. Now, this is insofar as refund is concerned. Now, come to the case of default by the assessee, the other way around. Now, what the language says is that the default is made after the commencement in the payment of any sum due under such proceeding. Default itself is made. Default itself is made after the new Act comes into play. So, it doesn't deal with the default made in the old regime. It doesn't deal with the default committed in the old regime. Default committed in the old regime is continued to be governed by clause C, and the old Act would apply. Now, take a similar situation as refund. Default takes place now, notice of demand would come now, and I commit the default, I don't pay, discharge the demand within 30 days. 220 subsection 2 interest would run from what date? After the lapse of 30 days. So, the whole of period itself is covered within the new Act. But then they say, because the default has taken place in the new regime, from 1st of April, though it relates to the past tax period, we will apply the interest levy provisions under the new law. Now, if at all for the default that takes place now, we'll have the period going back into the old law, then there is no provision which is available to them to levy interest under old law. Like how they could have refused interest to you under, in respect of, like period up to 31st March of 2026, you can also refuse to pay them interest in respect of the past period where the default takes place now. So, we'll have to imagine situations where you will possibly get covered here and try to make a claim and see how lucky you are. With this, clause H. Clause H says, where a deduction has been allowed in the 1961 Act or an exemption has been given under the 1961 Act, subject to compliance with certain conditions. Which conditions are not one-time conditions, continuing conditions, which will spill over to the new act. And if the breach takes place during the new regime, then they say that it shall be deemed to be the income of the tax year in which the violation takes place. And it will be included in your income under the same head of income in which it would have been included had the act not been repealed. Take situations of section 54 exemption, where you would have put the money into capital gains account scheme, you are deemed to have purchased a new house and the exemption would have been granted to you. But then within 3 years you are expected to utilize the money that is lying in the capital gains account scheme. So 3 years is the continuing condition, and imagine the 3 years will spill over to the new regime and there is a breach where some money is left unutilized, and then they would say it will be charged to tax in the tax year in which the breach takes place. The conditions of old act continuing in the new regime, and you commit a breach thereof, you will have to be paying tax in respect thereof. Another example could be 54F, where there is a condition that if an exemption is given to under 54F, you shall not buy another house within next 1 year, you shall not buy a second house within next 3 years. These conditions, if breached, you would have problems arising here. This would apply only to the, for example, special reserve which you have created under section 10AA. The exemption would have been granted to you. Exemption would have been granted to you on the premise that you have to utilize it within X many years, 5 years, which you don't end up utilizing. Then you will get hit here and you will be troubled. But this may not apply to 3618 reserve. In 3618 reserve, which a special reserve which the banks and the cooperative banks are permitted to make, or housing societies, housing banks are permitted to make, there is no question of allowing it to you on the premise that you shall not withdraw from the reserve. You are permitted to withdraw from the reserve, in which case it will be charged to tax, but that is not a condition upon which the exemption or the deduction would have been granted to you. So not all reserves, conditional reserves would get covered. 10AA reserve of SEZ could possibly get covered, whereas 3618 special reserve may not get covered, because it all depend on the basis upon which the deduction would have been granted. See, I just have listed some examples which possibly could be covered. You will have 54F, you will have SEZ reserve, you will have 11.2, 11.3, ATC condition. There are conditions where you are expected to continue. You are not supposed to sell the house property, in respect of which the repayment of loan would have been considered in a 1.5 lakhs bracket. For 5 years you are not supposed to sell. So those conditions, if you breach in the new regime, you will get troubled. As I said earlier, 3618 may not be covered, rebates and reliefs are not covered. Section 41 also would not be covered because it is not given on the basis of a condition, it is only a consequence provision. Clause I would not deal with because it is just the same as the existing clause. J will deal with agreement entered into, appointment made, approval given, recognition granted, circular, direction, instruction, notification, order or rule made under old law will be deemed to be made under new law. So if we have some problems here, like the situation that are actually covered will be double taxation avoidance agreements and all would now be continued by virtue of this. Appointments made of special auditor would continue. Approval granted for a charitable trust for 5 years, spilling out to the new regime will continue. Circular issued would continue, direction issued would continue, the notifications issued would continue, removal of difficulty orders that would have been issued under old law will continue. But the rule to continue would be, like it looks a little funny because they are going to bring a new set of rules. So here they are saying the rule would continue. Had they kept quiet, section 24 of the General Clauses Act would have dealt with it. What does section 24 of the General Clauses Act say? It says that any notification, order, etc. made under a repealed enactment would continue to apply in the case of reenacted law. That would have been sufficient, except when it is not inconsistent with the new law. Till such time it is rescinded by the new law and a new rule is made. That would have been sufficient for them. But now there will be a lot of like issues that would arise where you run with parallel rules. For example, old rule will not go now. New rule also will apply. You will have a set of 2 rules. Which one you would apply? What favors you most? That question would arise, and the courts will have to get in here to issue their interpretations in respect thereof. Yeah, then see, we have some very interesting provisions. I'm sorry, I'm holding you from your lunch. We will now get into, yeah. See, MAT credit, Mr. Padam mentioned, unutilized MAT credit for rest of the period, you will continue to get in the new regime, but the change is, we'll have to follow the new set of sections dealing with that, not the old set of sections. Typically what would happen, the legacy thing that would continue in the new regime, we are expected to comply with the law then existing. But here it's an exception. For MAT credit and the AMT credit, you shall comply with new law for the rest of the period. Yes. This is an important provision. Given greater time available, we would have discussed this at length. See, what it says is, in simple, it looks at the carry forward position. This is extremely important from practical point of view. You will have these many sections, 71B dealing with house property, 72 business laws, 73 speculation, 73A is specified business, and 74A is activity of owning and maintaining racehorses. These are the 4 categories where the present regime permits you to carry forward. Now, what they are trying to say is, these losses, meaning legacy losses, that would remain as of 31st March of 2026 would be allowed to be carried forward and set off, subject to you continuing to comply with these provisions, not the new law. These sections only, till the loss is exhausted, you will have to keep complying with these provisions. Then you will get the benefit of carry forward and set off. 2-3 issues that would arise here is, what about section 79? 79 is a case where no carry forward would be allowed if there is no preservation of shareholding up to 51%. So there has to be preservation of shareholding. What are the 2 cut-off dates reckoned? The last of the previous year in which the loss is suffered, and the last of the previous year in which the loss is sought to be set off. Between these 2 dates, there has to be minimum 51% common shareholding. This is a condition not coming in the respective section, this is a condition coming separately. But the condition is repealed. It is not continued. And the corresponding section in the new act only refers to the present situation and the losses that have arisen under new law. It would not deal with the case of a loss that arose under old law. So there is a significant gap here in as much as for all the legacy laws, it's a potential possibility for you to argue that section 79 does not apply. Second is the case of business reorganization. Section 72A deals with different forms of business reorganizations. I will put them into two baskets. One basket is amalgamation, corporatization, where sole proprietor is converted into company under 4714, partnership is converted into company under 4713, limited company is converted into LLP under 4713B, all these will fit into one category. Demerger will fit into another category. The reason is, in the first category, it is provided in various subsections of 72A that the loss of the predecessor shall be deemed to be your loss and the corresponding provisions of the act would apply. Meaning, section 72A, if there is an amalgamation, and the legacy laws that would continue would be Under section 72, what 72A1 says is, if there is an amalgamation, the predecessor's laws shall be deemed to be all laws and it will be allowed to be carried forward and set up in accordance with section 72. So in the first category, there is a reference made to these sections. There is a reference made to these sections. So it's possible for you to comply with those sections and continue to get the benefit. Whereas 72A subsection 4, which is demerger, doesn't say that the other provisions would apply. If you read section 72A4 carefully, it says if there is a demerger, then the loss of the demerged entity shall be deemed to be that of the resulting entity, and resulting entity shall be allowed to carry it forward eternally, and notwithstanding anything contained in rest of the sections of the Income Tax Act. So there is an evergreening of losses in the context of demerger, but then because it does not refer to any of those sections, and for the purpose of transition only these sections are referred and 72A is not referred, you run a potential risk of losing the benefit in the case of demerger. Because they may argue, like how we took an argument for 79, revenue might take an argument that 72A is not transitioned into new law, and 72A4 does not refer to section 72, which is captured in the table here, therefore I will not give you the benefit. And one more thing, those of you who are advising on business reorganization will have to be very careful. Don't go, if you are fixing the merger date, etc., don't have an appointed date beyond on or after 1/4/2026. Even if the merger would take place later, the court order would take place later, have the appointed date on or before 31st March of 2026. The problem is, if the amalgamation takes place on or after 1/4/2026, there is no proper suturing of the provisions of 72A of the old regime and the corresponding provision in the new regime. This would create hell a lot of problem. All the legacy laws may be lost if the amalgamation takes place on or after 1/4/2026 appointed date. So, you have to be mindful of that, and if it is inevitable, you have to be aware of what loss you will have by having this appointed date post 1/4/2026. So, with this, there are a few more clauses. There is one more. See, 74 is missing here. They have brought in a separate clause and created a problem for themselves. Look at clause N. What was the need to have created a separate clause for capital loss? It could have been added in another line. They would have saved at least 100 words. 100 words, and not only they have lost 100 words, they have given us a very unique opportunity when you make a fine comparison between M and N. Look at N carefully. They say against the income under the head capital gains. That means they are very, very, very specific. Capital loss can be adjusted only against capital gain. This is how we understood even in respect of business loss, correct? What's our understanding of business loss? Business loss can be set off only against business gain. Now that in clause N they have specifically mentioned this clause, go back to clause M. They are not so mentioned. Look at this. Shall be set off and carried forward against the income computed under this act, subject to compliance with the procedure of those sections. What is the procedure of those sections? What is the manner provided? Manner provided, would it include just the period, or would it include against what it should be set off? If you would argue that it would also include against what income it should be set off, then what is the need in clause N to say that it shall be set off only against capital gain? The fact that they are specific in clause N that it shall be set off only against capital gain, and they are not so specific in clause M, would make us tend to think that, look, going forward, all these legacy laws can be adjusted against any income. This problem is created by them only by shooting themselves their foot. So what was the need to have carved out another clause like clause N with a different language? Then we will try to compare and say that they are more specific, they are less specific here, and therefore the income should be allowed to be set off against anything. Now, there is another clause that deals with 47A situations. There again, they have made some serious error. If 47A has two categories. In one category, which deals with holding to subsidiary, subsidiary to holding, transfer of a capital asset, which is exempt. Rest would be cases of the corporatization, etc., where you have some continuing conditions, like your partnership is converted into company. For 5 years, the erstwhile partners together will have to hold not less than 50% of the share in the converted company. So, there are continuing conditions. There, if there is a breach of condition, it will be charged to tax in the hands of the successor. Whereas, from holding to subsidiary and subsidiary to holding, the transfer that was exempt, if there is a breach of condition, there are two conditions that will have to be kept. One is, for 8 years, the holding company shall not cease to hold whole of the share capital of the subsidiary company, and the transferee company shall not convert the capital asset into stock in trade for 8 years. If there is a breach of condition, then successor would not be charged to tax. They will go back to the year of transfer and do a rectification and seek to tax the transferor. There, they have said that while we seek to tax the transferor in the year of transfer, we will tax them under new law. How is it possible for them to apply new law for the past year? So, there is a full goof up from their end insofar as 47A is concerned, as it relates to the transactions between holding and subsidiary. I think with this we have overshot by a good 15 minutes. I would, Mr. Padam would join me in thanking you all for having very patiently heard. You will have to excuse us for getting too technical about it, but then we do not get this opportunity far too often. So, that is why we thought we will go completely academic about it, and its implications are up to you to fathom and apply, not apply, depending on how and when it suits you. Thank you one and all.
A very good afternoon, members. On behalf of Bangalore branch of SARC of ICI, it's my privilege to extend our heartfelt gratitude to CA H. Padamchand Khincha sir and CA Chythannya sir for delivering a truly wonderful and insightful session for today's session. Your in-depth presentation on structural changes and overview of the new Income Tax Act, along with the detailed coverage of repeals, savings and charging provisions under the new Income Tax Act 2025 has immensely enriched our understanding. The practical illustration and the real-time explanation shared by both the esteemed speaker made the complex provision extremely clear, meaningful and easy to relate. We are deeply grateful for the time, knowledge and the effort you have contributed to benefit our members. Members, a big round of applause for both our esteemed speakers. Now, may I call upon Chairman of Bangalore Branch, C.A. Manjunath M. Hallur, to present a token as a respect and gratitude on behalf of Bangalore Branch members and member present here to C.A. H. Padamchand Khincha sir and K.K. Chythannya sir. Thank you, Chairman sir. Thank you once again, sir, for your gracing occasion and for your valuable contribution.